The financial sector plays a fundamental role in the economy of Indonesia, one of which is to be the source of financing to support Indonesia's ambition and aspiration of becoming one of the top 5 largest economies in the world by 2045. By then, the nominal GDP of Indonesia is expected to reach more than $7 trillion, with GDP per capita increasing to 5 to 6 times greater than its current position. To finance such a large project, the role of the financial sector needs to be broad-based and balanced at the same time. However, when examined from the current conditions, Indonesia's financial sector is still relatively underdeveloped. In 2020, Indonesia's total financial sector assets are still around 115% of the nominal GDP, while the average of developed economies' financial sector at least around 300% of the country's nominal GDP. A well-balanced development of the banking and the non-bank financial sectors is a common feature of a developed country's financial sector. The financial asset structure of Indonesia currently is still very much concentrated around the banking sector and the capital market. Meanwhile, the non-bank financial institution sector, especially insurance and pension fund, is still very small in terms of the asset size. Therefore, a rapid and sustainable growth of the insurance and the pension fund sector is going to be a major agenda of the financial sector development of Indonesia in the next 2 decades. Insurance and pension funds are among the largest investors in the financial market, allocating a significant portion of their assets to capital market instruments, typically around 80% of their total assets. Economic downturns can indeed impact their investment returns, which in turn can affect their ability to fulfill policyholder obligations. So the role of investment strategy, risk management, and good corporate governance are among the essential traits in the overall development of a prudent, competitive, and sustainable insurance and pension fund ecosystem in Indonesia. However, the insurance penetration and the financial inclusion rates index of Indonesia are still relatively low in comparison to the ASEAN 5 countries. The low penetration and inclusion rates in Indonesia are also confirmed by the literacy survey conducted by IFG Progress. In general, the survey found that insurance literacy at the university level in Indonesia can be classified as moderate. Furthermore, when viewed based on the dimensions of literacy, most respondents are still moderately literate in the understanding dimension and are classified as quite low in literacy for the knowledge dimension. As a strategic state-owned holding company in the sector of insurance, underwriting, and investment services, Indonesia Financial Group, or IFG, through its think tank IFG Progress, present the second annual IFG International Conference aims to cement further the commitment of the Indonesian Financial Group, or IFG, to provide platform for policymakers, industrial players, and other relevant parties to discuss and debate current and future challenges facing the development of the insurance and pension fund in Indonesia. As for the first IFG International Conference, the discussions in the second annual IFG Flagship International Conference will start with an update of the ever-changing global economic and financial landscapes. On the pension fund, the focus will be on the liability-driven investment strategy. The conference will then touch upon several immediate and structural challenges facing the insurance industry, from the implementation of the IFRS 17 and the vast opportunities awaiting the micro-insurance and Sharia insurance sectors. The conference ends with a special session debating issues surrounding the adoption of the insurance guarantee scheme in Indonesia as stipulated under the newly passed Bill on the Development and Strengthening of the Financial Sector. financial sector plays a fundamental role in the economy of Indonesia, one of which is to be the source of financing to support Indonesia's ambition and aspiration of becoming one of the top 5 largest economies in the world by 2045. By then, the nominal GDP of Indonesia is expected to reach more than $7 trillion, with GDP per capita increasing to 5 to 6 times greater than its current position. To finance such a large project, the role of the financial sector needs to be broad-based and balanced at the same time. However, when examined from the current conditions, Indonesia's financial sector is still relatively underdeveloped. In 2020, Indonesia's total financial sector assets are still around 115% of the nominal GDP, while the average of developed economies' financial sector at least around 300% of the country's nominal GDP. A well-balanced development of the banking and the non-bank financial sectors is a common feature of a developed country's financial sector. The financial asset structure of Indonesia currently is still very much concentrated around the banking sector and the capital market. Meanwhile, the non-bank financial institution sector, especially insurance and pension fund, is still very small in terms of the asset size. Therefore, a rapid and sustainable growth of the insurance and the pension fund sector is going to be a major agenda of the financial sector development of Indonesia in the next 2 decades. Insurance and pension funds are among the largest investors in the financial market, allocating a significant portion of their assets to capital market instruments, typically around 80% of their total assets. Economic downturns can indeed impact their investment returns, which in turn can affect their ability to fulfill policyholder obligations. So the role of investment strategy, risk management, and good corporate governance are among the essential traits in the overall development of a prudent, competitive, and sustainable insurance and pension fund ecosystem in Indonesia. However, the insurance penetration and the financial inclusion rates index of Indonesia are still relatively low in comparison to the ASEAN 5 countries. The low penetration and inclusion rates in Indonesia are also confirmed by the literacy survey conducted by IFG Progress. In general, the survey found that insurance literacy at the university level in Indonesia can be classified as moderate. Furthermore, when viewed based on the dimensions of literacy, most respondents are still moderately literate in the understanding dimension and are classified as quite low in literacy for the knowledge dimension. As a strategic state-owned holding company in the sector of insurance, underwriting, and investment services, Indonesia Financial Group, or IFG, through its think tank IFG Progress, present the second annual IFG International Conference aims to cement further the commitment of the Indonesian Financial Group, or IFG, to provide platform for policymakers, industrial players, and other relevant parties to discuss and debate current and future challenges facing the development of the insurance and pension fund in Indonesia. As for the first IFG International Conference, the discussions in the second annual IFG Flagship International Conference will start with an update of the ever-changing global economic and financial landscapes. On the pension fund, the focus will be on the liability-driven investment strategy. The conference will then touch upon several immediate and structural challenges facing the insurance industry, from the implementation of the IFRS 17 and the vast opportunities awaiting the micro-insurance and Sharia insurance sectors. The conference ends with a special session debating issues surrounding the adoption of the insurance guarantee scheme in Indonesia as stipulated under the newly passed bill on the development and strengthening of the financial sector.
Welcome to all of our distinguished guests. Thank you for joining us at the Indonesia Financial Group International Conference 2023, Shaping the Foundations for Sustainable and Resilient Insurance and Pension Fund. For those of you who have arrived at the venue, please proceed to the main ballroom and kindly take your seats as we will begin our event shortly. Ladies and gentlemen, and distinguished guests, thank you for joining us at the Indonesia Financial Group International Conference 2023, Shaping the Foundations for Sustainable and Resilient Insurance and Pension Fund. For those of you who have arrived at the venue, please proceed to the main ballroom and kindly take your seat as we will begin our event shortly. Thank you. Welcome to all of our distinguished guests. Thank you for joining us at the Indonesia Financial Group International Conference 2023, Shaping the Foundations for Sustainable and Resilient Insurance and Pension Fund. For those of you who have arrived at the venue, please proceed to the main ballroom and kindly take your seat as we will begin our event shortly. Ladies and gentlemen, we're about to start our event shortly. Please be seated. Thank you. Distinguished guests, ladies and gentlemen, please rise for the Indonesian National Anthem. Ladies and gentlemen, please rise for the Indonesian National Anthem. Indonesia Raya. Please be seated. Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera, Om Swastiastu, Namo Buddhaya, Salam Kebajikan. Good morning, Excellencies, distinguished guests, ladies and gentlemen. Welcome to Indonesia Financial Group International Conference 2023. Shaping the foundations for sustainable and resilient insurance and pension fund. First of all, let me introduce myself. My name is Shafira, and it is an honor for me to be here to be the host of the most progressive international conference of insurance and pension fund. On behalf of the committee, allow us to convey our sincere gratitude to all of you who attended today's conference, both in person and virtually. On this prestigious occasion, we want to extend a warm welcome to our guests of honors and speakers. First of all, I would like to welcome and greetings Bapak Mirza Aditya Suara, Vice Chairman of the Board of Commissioners Otoritas Jasa Keuangan. Selamat pagi, Bapak. Selamat pagi and welcome to Bapak Suhasil Nazara as a Vice Minister of Finance, Ministry of Finance, Republic of Indonesia. Selamat pagi. Ibu Nawal Nelly as a Deputy for Finance and Risk Management, Ministry of State-Owned Enterprises, Republic of Indonesia. Selamat pagi Ibu, selamat datang. And welcome to Main Commissioner concurrently as Independent Commissioner, Indonesia Financial Group and all the members of Board of Commissioners, Bapak Fauzi Ihsan. Selamat pagi. Bapak Haru Kusmahargyo as a Vice President Director Indonesia Financial Group and all the members of Board of Directors. Good morning. Dan selanjutnya the officials of Otoritas Jasa Keuangan, Ministry of Finance and Ministry of State-Owned Enterprises of Republic of Indonesia, the Audit Board of the Republic of Indonesia, and Indonesia's National Government Internal Auditor. Good morning and welcome. And also Board of Directors of all SOE companies, IFGs, subsidiaries, and sub-subsidiaries, representative of the Insurance Industry Association, representative of IFG stakeholders, and all invited guests and participants. Excellencies, distinguished guests, ladies and gentlemen, the Indonesia Financial Group, IFG, is hosting its second annual international conference to discuss and debate challenges in developing the insurance and pension fund in Indonesia, with the theme of shaping the foundations for sustainable and resilient insurance and pension fund. The conference will cover the update of the ever-changing global economic and financial landscapes, liability-driven investment strategy for pension fund, structural challenges facing the insurance industry, and also the opportunities. The conference ends with a special session on the issues of the insurance guarantee scheme. Distinguished guests, ladies and gentlemen, to start our main conference, it is a pleasure for me to call upon the Vice President Director of Indonesia Financial Group, Bapak Haru Kusmahargyo, to the stage.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera, Om Swastiastu, Namo Buddhaya, salam kebajikan. Excellencies, Bapak Mirsa Aditya Swara, Vice Chairman of the Board of Commissioners of Financial Services Authority, Bapak Suhasil Nasara, Vice Minister of Finance of the Republic of Indonesia, Ibu Nawal Nelly, Deputy Minister of State-Owned Enterprise, Ibu Sali Salamah, Vice Chairman of State Accountant of Indonesia National Government Internal Auditor, Bapak Fauzi Iksan, Chairman of the Board of Indonesia Financial Group, all distinguished speakers, members of the Board of Commissioners of IFG, Board of Directors of IFG, and Board of Directors and Commissioners of IFG Group and affiliates, distinguished guests, ladies and gentlemen. On behalf of my colleagues at IFG, I extend a heartfelt welcome to our distinguished guests, speakers, and participants of the second annual international conference as we approach the Financial Inclusion Month in October. The theme of this year's conference is shaping the foundation for sustainable and resilient insurance and pension funds. Carries a profound resonance. The topic that we are set to deliberate upon are not just timely, but in fact they are utmost urgency. They hold the power of scope to trajectory of Indonesia financial sector and economic for the decades ahead. The IFG International Conference convenes 22 global experts, representing a variety of perspectives ranging from global and regional to domestic viewpoints. We extend a cordial invitation to all participants of the IFG Group Conference 2023, encouraging you to immerse yourself in enlightening discussion that revolve around the transformative potential of rapidly evolving ecosystem and the role in augmenting insurance and pension fund. Our conference will also serve as a nexus, bringing together hundreds of eminent practitioners, industry practitioners, regulatory authorities, and scholars from worldwide financial domain. In summary, the IFG International Conference 2023 promises to be a two-day intellectual feast centered around several sub-themes. The objective of this conference are manifold: to elucidate the potential ramification of prevailing macroeconomic landscapes on the insurance sector at large, to provide a comprehensive update on the current state of the pension fund sector in Indonesia, along with the challenges, and to delve into intricacies of the liability-driven investment, or LDI, allocation strategy employed by pension fund. On the second day, our focus pivot toward an exhaustive examination of myriad facets within the insurance sphere. We will address both immediate and long-term challenges with equal vigor. The immediate challenges encompass the implementation of IFRS 17 and the intricacies of micro-insurance. Meanwhile, the long-term horizon beckons us to explore the emergence of new ecosystem for the insurance sector. This encompasses the profound impact of digitalization and potential of Sharia-compliant insurance, particularly salient for Indonesia, the world's most populous Muslim nation. We also would like to discuss the recently passed law on development of strengthening on financial sector reform, known as P2SK law, mandates the establishment of insurance guarantee scheme within 5 years. Recent studies by IFG Progress highlight the different approaches taken by various countries in designing the insurance guarantee schemes, covering aspects such as protected products, funding schemes, fund management, resolution approaches in case of insurance failures, and the role of reinsurance. At this juncture, we would like to extend our profound gratitude to the Ministry of State-Owned Enterprises for their invaluable guidance and direction, which has been instrumental in shaping IFG's strategic and policy framework. Our sincere thanks also go to Otoritas Jasa Keuangan, whose unwavering support has been pivotal in fostering good corporate governance, notably through the specialized regulation outlined in POJK 13/2022. And lastly, we extend our gratitude to the Ministry of Finance for the invaluable capital injection which has enabled IFG to operate in manner befitting its stature. Distinguished guests and colleagues, I'm eagerly anticipating the insight that will emerge from our discussions on the aforementioned topics. Moreover, the next 2 days, I've been informed that we have received registration from well over 550 public participations for the conference, along with around 250 total invitees. Given that conference room can only accommodate around 200 participants, we have arranged an additional room with the live coverage of the discussion in this main hall and have extended access to online participants. I want to express my gratitude once again for your active participation and hope that we can all derive valuable insight from this fruitful discussion. With that, I conclude my speech. Wassalamualaikum warahmatullahi wabarakatuh. Santi, Santi, Santi Hum.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you, Bapak Haru Kusmahargyo, to open and welcoming all of us here at the opening ceremony of IFG International Conference 2023. All right, ladies and gentlemen and distinguished guests, shall we move on to the next keynote speech that will be delivered by the Vice Minister of Finance, Ministry of Finance, Republic of Indonesia. Please welcome Bapak Suhasil Nazara.
Rame juga ternyata ini. Assalamualaikum warahmatullahi wabarakatuh. Selamat pagi, salam sejahtera untuk kita semua. Om Swastiastu, Namo Buddhaya, salam kebajikan. Ladies and gentlemen, distinguished speakers, and also my colleagues from OJK, Pak Mirza Aditya Swara, Ibu Nawal Nelly from the Ministry of State-Owned Enterprise, and also colleagues from IFG, and also all participants of this international conference held by IFG today. It is my pleasure to be here. I was contacted by Pak Reza long time ago, and then I reserved my schedule in order to make sure that it will be on my schedule for sure. It is my pleasure to speak before you all, and I would like to convey several messages that I would like to share with you. I believe that many speakers later will talk more about the financial sector, even more specifically about the insurance and the pension funds. Let me start with the current state of economy that we are in right now. Our understanding about the current state of economy, if we look at Indonesia and we look at the global, this is a very, very uncertain times. The current global uncertainty remains elevated. That is correct. the inflation start to go down, but it is not yet low enough for the many of the advanced countries to lower their interest rates. Interest rates still high. It seems that many discussions in many international fora mention about the higher for longer. The interest rates will remain high for a longer period of time. We have to watch this. The other thing that is also happening is that the high inflation in the global world have made a lot of countries to look at this come up with the different names, the onshoring, the friendshoring, connecting with friends only, connecting with alliance only. This is something that we must be watchful. And if we look at the Indonesian economy, of course, we are very, very grateful. Our growth is still 5.2% last quarter, and our inflation relatively low. And then the government has been very, very, we are very, very vigilant with the economic situation, and our state budget remain on the right track. What do I mean by remain the right track? In the last 3 years, when we fight the COVID, we use the fiscal policy to be upfront for the economy to handle the health, to handle the spending, the social protection, and other things that can cover for the people's health and people's economy. As a result, the state budget was working so hard. Deficit expanding, and after expansion of the government state budget deficit, it is very important that the state budget is back to its consolidation. So this is something that we have already shown, and you follow the numbers, how the government budget is consolidated in the last couple of years. And this is possible for our country because we know that the economy is very resilient. In many countries, what many countries are afraid of when they do the fiscal consolidation is that government budget, lower deficit in the government budget, and then lower impact to the economic growth. That is not the case in Indonesia, despite the fact that we consolidate our fiscal budget, economy continued to grow. The last growth was 5.2%. Now, I can talk a lot about this episode, but then one thing that I would like to tell you in this very good morning is that despite the fact that the government is handling the COVID, despite the fact that we are tied up with so many health issues, social protection issues, income of the people during the COVID period, but if you remember, that time we continue to reform. What are the reforms? We continue to issue so many, we continue to look at the further down the line. What should the Indonesian economic landscape should look like in the next decade, for the next decade to come, for the next decade to come? So we issued the Undang-Undang Cipta Kerja. In the middle of our COVID, we issued our tax law in the middle of COVID. And as was mentioned by Pak Haru earlier, we also issued the financial sector omnibus law. And that is also, the discussion was in the middle of the COVID. We reform. We are not stuck with the only handling the COVID, but we continue to reform our economy. And of course, all of those reforms are expected, we are expected to see the new landscape of Indonesian economy in many years to come. And that, of course, brings us to the financial sector. What are the objectives of our financial sector? Three most important objectives. Number one, we would like to continue deepening our financial market. Indonesian financial market should be deepened further, the financial deepening. Number two, financial inclusion. For the financial inclusion means that we would like to include more and more people, more and more segment of population, and provide the financial services to all of Indonesians. Financial deepening, financial inclusion, and number three is the financial stability. And for the financial stability is very important. Three objectives of Indonesian financial sector policy: financial deepening, financial inclusion, and financial stability. And the government is working hand in hand with many other institutions, agencies. We work very close with the central bank, we work very close with the OJK, we work very close with the LPS in order to come up with this deepening the financial market, make the financial market more inclusive and more stable. Now, and I believe that many speakers will talk more about this, especially in the area of pension and also insurance. Let me use this opportunity to highlight the pension and insurance. What are our homeworks in the insurance and the pension? I believe that in the insurance we have a very big homework, namely making sure that the governance is better. We have to enlarge our insurance, deepening the insurance market, and the potentials are big. If we look at the let me go to my slide first. In the insurance reform, we would like to make sure that governance is put in place. We have to improve, we have to strengthen the confidence in our industry, in the insurance industry. And of course, IFG is playing a very important part in this. As part of the state-owned enterprise, IFG is playing a very, very important role. And of course, our colleagues from OJK is going to look at this very carefully. The mutual insurance as part of the insurance industry also needs good governance, good corporate governance, and also good structure. We also introduced the policyholders protection program. I believe many will talk about this later. But I would like to move very quickly. I'm not going to go into depth in here. The pension industry. Our main problem, our main situation is the low coverage of the pension system. And I think the other problem that we have to handle, in addition to the dissemination, expansion of the coverage, is also the benefits withdrawal. The current condition of our pension industry will require that we go out and get more people into the Indonesian pension system. I also believe that many will talk more about this, so I'll stop there. Because I would like to use the remaining time to talk about the non-financial thing. We have the financial sector. We have the banking, we have the insurance, we have the pension, we have the the financial market. And we know that one of the most important role of the financial sector is as the intermediaries, protecting people and also the intermediaries, channeling funds from those who have funds to those who need funds. The question is, what kind of economy are we looking at so that there's intermediation can go? I would like to share with you 4 areas which I believe is the future business where the financial sector should pay attention to. 4 areas are the following. Number 1, because we have just got out from the COVID. One of the COVID episode in our economy told us that health sector is actually a source of growth. Health sector can be the source of growth. The fact that we also issued the new law on health, I believe our financial sector should look at this very carefully and then see the space, the business space on health sector. We must be ready for we must be ready to handle the pandemic. We have already shown the way we handled the pandemic. We have already shown what is the impact to the financial sector. We have to learn from that, and we must be ready for the health sector of Indonesia. In the global world, Indonesia is one of the promoters of the pandemic fund. This is an area that is very, very new. Ministry of Finance, the World Bank, is looking at the pandemic fund. So I really hope that at some point, Indonesian financial sector can take a look at this and see what is the role of financial sector in the pandemic preparedness, in the health preparedness of our country. 270 million people, we must get our economy ready for the health issues. The fact that we enacted the health law provides new space for improvements as well as new spaces for business. So that is one thing that I would like to convey the message. You look at it from the pension point of view, you look at it from the insurance point of view, go ahead. So that is number 1. There is number 2. The new Indonesia will be characterized with the more downstreaming of our natural resources. That is also, some of you already followed the news, the discussion out there. Some discussion says about the export ban, but this is not about the export ban. This is about the downstreaming of our natural resource that we have. We have seen so many ideas. We always say Indonesia is rich of natural resources. At this point, our president is very, very committed. The natural resource should be downstreamed in Indonesia. Hilirisasi industry. This is the new this is the new landscape. If we do it right, this is going to be the new landscape for Indonesia. I would like to encourage the financial sector to look at this very carefully and then get the best out of this vision. It's a very big vision, and I believe that we are on the right track by telling the economy we need the downstreaming, we need the domestic value added. We can invite the international capital. but there's going to be domestic value added that we chase, and the financial sector, I really hope, will play a very important part on that. So that is number two. Number three is that the realm of digitalization in the world. This is a challenge as well as an opportunity. The world is becoming more and more digitalized. This is more than just robots. This is more than just the production process that is more and more electronic or more robotic. We get into the time where we are going to interact. The interaction would be with the machine interaction. Not only the machine that is programmed, but the machine who can interact with human. And of course, this is going to be a challenge. It should also be the opportunity. Can you imagine that one day somebody will come to one of the financial institutions, it can be state-owned enterprise, it can be private, go to one of the insurance company, for example, and then sitting in front of the help desk of that insurance company or the pension fund company, asking questions to the account representative, but at the same time, he or she is typing the same question to the ChatGPT. That is the kind of world that we are going to enter. The digitalization in the sense where human will interact with machines and where human will, we have to make sure that we work in a very, very clear and very neat, rapi. All of our industry, pension industry, insurance industry need to be very, very governed. Digitalization will also be part of the very important ways of how we conduct the public services. And we start to think about that. What kind of public services that we have to think about in the face of digitalization. So this is more than just apps. This is more than just robots. This is getting into the time when interaction with machines going to define our economic life. And of course, I also expect the financial sector will take the benefit of this. This is something that must be thought over. How can we improve the confidence? How can we improve the governance? And how can we improve a lot of areas? And number 4, the last point that I would like to say about reforming our economy is the green. This is also the new reality where green economy is going to define the new business in Indonesia and also in the world. In the next couple of weeks, maybe even days, Indonesia will start the carbon market. We are entering the energy transition mechanism. We are offering a lot of our ideas in the international fora about the just and affordable transition to the green economy. I really hope the financial sector will find your place in the agenda. What is the pension? What is the banking? What is the role of insurance in this area? Because this is going to define us. A lot of ideas will be a little bit more like an uncharted territory. When we go into the green economy, especially about the carbon market, we start to think about the compliance market, the voluntary market, and the financial sector need to make sure that you know your way in there. OJK has already issued the taxonomy, the green taxonomy. This is going to define what is green, what is somewhat green, or what is not green. And of course, as a regulator, the government, OJK, BI, and also LPS, we will continue to work together to make sure that the stability of financial sector is continue. And we appreciate your business, especially IFG as part of the government state-owned enterprises, to set the tone on many things that we have to set the tone, not only domestically, but also internationally. And I would like to close this with, once again, an appreciation to the colleagues of the IFG who conduct this international conference. This is one way to tell the world what we have already done, and we are ready to set the tone. It is very important because 4 areas that I mentioned earlier is going to define Indonesia in the future. Thank you very much for your attention. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you, Bapak Suhasil Nazara. Kindly remain on stage. We will have a photo session, and regarding on that, I would like to invite Bapak Haru Kusmahargyo, Ibu Nawal Nelly, Bapak Mirza, and Bapak Fauzi Ihsan to join with Bapak Suhasil Nazara on stage, and we will have a picture together. We will have a photo session. And for the media partner, please stand beside the stage, on the side of the stage in front of the IFG totem. Kepada teman-teman media, boleh ke arah sebelah kiri panggung, tepatnya di depan totem IFG. Okay, thank you so much Bapak Suhasil Nazara and Ibu Nawal. Ibu Nawal, kindly remain on stage. Once again, ladies and gentlemen, let's express our sincere gratitude for Mr. Suhasil Nazara for your presence. Thank you so much. Ibu Nawal, please kindly remain on stage. And thank you so much, gentlemen. Thank you to Bapak Haru Kusmahargyo, Ibu Nawal tentunya, Bapak Mirza and Bapak Fauzi Ihsan. Please give a round of applause to the Vice Minister of Finance, Ministry of Finance, Republic of Indonesia, Bapak Suhasil Nazara. Thank you so much for your presence. Thank you so much. And ladies and gentlemen, we're going to move on to our next agenda. We will hear the other keynote speech by Deputy Finance and Risk Management Ministry of State-Owned Enterprises of the Republic of Indonesia, Ibu Nawal Nelly. The stage is yours.
Assalamualaikum warahmatullahi wabarakatuh. Selamat pagi Bapak Ibu sekalian, ladies and gentlemen. Good morning, and thank you for having the perspective of the Ministry of SOE in relation to the view of the insurance and pension fund industry. This industry, this cluster, the insurance and pension fund, is a very strategic cluster within the ministry. Of our total asset of $640 billion US, consolidated asset of the portfolio SOE, the insurance and pension fund cluster account for 5% of that cluster. This is ranking this cluster the 4th largest cluster in our portfolio in terms of size and in terms of importance. Now, let me go back a bit to history. 1997, 1998. We're very thankful for the financial crisis for teaching us a very valuable lesson about the importance of the health of the financial sector. At that time was the banking sector. Now, thanks to OJK's continuous monitoring and initiatives and governance reforms within our Himbara cluster, the banking sector, our banking sector is the healthiest not only in Indonesia, but in the region. The COVID-19 triggered another crisis that we should learn from. COVID-19, like what Vice Minister Sua mentioned, taught us the importance of the health cluster and the insurance cluster. As such, in 2022, the first cluster that we formed, the first 2 holding companies that we formed were the holding company of IFG to house the insurance clusters and the cluster for biopharma to house the healthcare cluster. Going forward, we believe these 2 clusters, although still small now, will play a significant role in shaping the growth of Indonesia and in shaping the health, not only health of physical, but also financial health of Indonesia in general. In the ministry, we have initiatives to transform and improve the governance of 2 segments within the insurance cluster. The general and life insurance segment, catering to the broader market, and the pension fund, catering to pegawai negeri sipil or civil servants and our army. In addition to that, we also streamlined or spearheaded initiatives with the help of IFG as well to improve the governance of pension fund managed by the individual SOEs. We call them Dana Pensiun, specifically Defined Benefit Pension Fund atau DPMP. We are very obliged with the help that was provided to us from regulators, from OJK, with the issuance of P2SK, or dubbed as the Omnibus Law for improving the health of financial sector, to allow us to perform and to manage activities and liabilities in a better way than we did before. The current regulation allows for a more progressive and proactive risk management, and this is quite important for the insurance and the pension fund industry. In the pension fund, we launched initiatives and spearheaded directions to all our SOEs to develop a roadmap to improve the health of each individual pension fund that they manage. So from now to the next 3 years, we are going to mandate our SOEs to improve dana pihak ketiga or equity injections in our pension fund, to allow them to sort of like have sufficient capitalization. We're also asking our SOEs to instill governance in terms of the investment, because there is no point of adding funding to a pool of pension fund if you don't have the proper governance set up and if you don't have the skill set to invest in the right places. We're also initiating, with the help of OJK, products that will allow the transition of our insurance fund, our pension fund, to allow them to better manage liabilities. In banks, we manage assets. In insurance and pension funds, we manage liabilities. The products to manage the liabilities need deepening, and this is something that we are very, very optimistic. The new Omnibus Law for financial sector will allow us to do So in a more structured and more with more solid governance. Finally, in IFG, we have high hopes in our holding company for insurance. We formed this holding company to allow the upscale of skills, scale of economies, and skill of actuaries to allow these knowledge to be transmitted not only at the holding company but also into the subsidiaries. Insurance turns out to be an industry that needs economies of scale. And to that extent, this merger was envisaged to allow the economies of scale to be transferred to the individual insurance companies that is under the portfolio SOE. We have high hopes from IFG as well that they will be able to set the benchmark of governance and reporting. This this next couple of years is an important milestone for the insurance industry, not only for IFG, but for insurance industry in Indonesia in general. New accounting rules, PSAK 74, will be launched, and this is a new accounting standard that will ask the insurance company to revisit how they report their assets and liabilities, specifically their liabilities. They're going to be asked to look at their portfolio contract by contract, yeah, and assess the risk contract by contract. Although my background is accounting, but I strongly believe that accounting has behavioral impact. What does it mean? If you record your portfolio right in your financial statement, it will trigger strategic behavior from the players to manage and mitigate the risk as reported in the financial statement. Our hope from the implementation of PSAK 74 is that by scrutinizing the individual contracts, pricing them right, contract by contract, and be honest about the requirements of provision for each of the contract, will allow you not only to sort of like price your product correctly, yeah, but also to manage your portfolio in a portfolio standpoint, to manage your product in a portfolio perspective. And this has a ramification not only on IFG, but also on the industry, because it is important that everybody price insurance product correctly. One player who misprice the insurance product, everybody will follow. So that's not a best practice. If you want an industry to grow, you have to start with the right information. And this PSAK 74 is the starting point. I know it will be painful at the beginning because it requires a lot of investment. But if you want to jumpstart the growth of the industry, right information at the very beginning is quite important. It will allow you to select the market correctly. It will allow you to price your product correctly. And it will allow you to assess your health correctly. So I am asking every single one of you, and I have the best mind in insurance in this room, is to sort of like embrace this with a positive intention. It does require a lot of investment at the beginning, but the reward will be beneficial because you will be starting with the right information. Now, let me close this. Insurance is an important industry in any developing and developed country. We have among the lowest penetration. We need to change that. And we need to change that because our population, as they age, they will need to rely on insurance product more. And as our economy grow, they will need more sophisticated and complicated insurance product to cover their business. I can't see growth without paired growth in the sophistication, variety of insurance products that are priced right, taking the right risk into account, priced right, and targeting the right market. So with that, thank you so much for the opportunity given to me to speak in this important session. Billahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you, Ibu Nawal Nelly. Once again, please give a round of applause to the Deputy Finance and Risk Management Ministry of State-Owned Enterprises of the Republic of Indonesia. And ladies and gentlemen, another insightful keynote speech will be delivered by the Vice Chairman of the Board of Commissioners of Otoritas Jasa Keuangan. Please welcome Bapak Mirza Aditya Suara.
Benar, banyak juga ya. Tadi masuk belum terlalu banyak, masih agak gelap. Assalamualaikum warahmatullahi wabarakatuh. Selamat pagi dan salam sejahtera bagi kita semua. Yang kami hormati, tadi hadir Pak Wamenkyu, Pak Suhasil. Pak Suhasil is also Commissioner ex officio at OJK. Friends from Ministry of Finance, saya lihat tadi ada Pak Adi Diarso. Ini Pak Adi yang salah satu orang yang membuat P2SK ini. My friend from SOE Ministry, Ibu Nawal Nelly, and colleague from SOE Ministry. The host is from IFG, Pak Haru, dan Board of Directors at IFG, ada Pak Pantro, Pak Heru, dan other friends in IFG, Pak Fauzi Iksan, President Commissioners and other commissioners. Saya lihat ada Busum dan Bapak Ibu dari komisaris, juga tentu ini di sini ada bedanya IFG and IFG Progress. What is the difference? Harusnya Pak Haru menjelaskan tadi. What is the difference? So let me explain. So IFG is the group of the financials, the BUMN. But IFG Progress is doing research. So doing research is not only for IFG, but actually for Indonesia. So give big applause to IFG Progress. So again, on behalf of me as an economist, so thank you very much for having research, doing research, not in banking sector. Too many already in banking sector. Betul Pak Raden Pardede? Yeah, my friends, Pak Raden Pardede, they are also the senior economists, that also expert staff at the Ministry of Menko Economy. So IFG Progress focusing on non-banking sector. It's very rare research in the non-banking sectors. And that's why it is called, the seminar is Shaping the Foundation for Sustainable and Resilient Insurance and Pension Funds. So, Kepala IFG Progress ini Pak Reza. Where is Pak Reza? Pak Reza is a senior economist, well known in internationals, and now focusing on this with IFG Progress. And also my friend in OJK that's coming here, Ibu Dewi. Ibu Dewi is a head of departments that doing the banking, insurance supervisions. So be careful with her. Yeah. And we have Pak Joni Eri here. Pak Joni Eri is a head of departments for regulations. Yeah. Regulations in the insurance and pensions. So thank you to Undang-Undang P2SK, because with Undang-Undang P2SK, now Pak Ogi, so I'm standing here on behalf of Pak Ogi because Pak Ogi is on overseas trip. So Pak Ogi can concentrate in asuransi, penjaminan, dan dana pensiun, insurance, guarantee, and pensions funds. Because previously the structure before Undang-Undang P2SK, so before January this year, Pak Ogi has to supervise, regulate insurance, pensions, guarantee, finance company, pegadaian, LKM, venture capital, apalagi Pak Joni? Hah? P2P, yeah. So too wide, sulit mau bisa fokus. So now Pak Ogi fokus on insurance, penjaminan, and pension funds. And Pak Agusman, the new commissioners that inaugurated in August, focus on the other industry like finance company, pegadaian, venture capitals, LKM, P2P lending, yeah. And will be coming under Pak Agusman, koperasi simpan pinjam. Bu Sum sampai ketawa. Koperasi simpan pinjam yang open ended, ya. Jadi koperasi simpan pinjam ada yang close end dari anggota untuk anggota, ada yang open. Jadi dari luar masukin dana dan doing lending juga. Jadi itu dinamakan open ended. And we have another new commissioners, Pak Hasan Fauzi, that in charge for digital innovation product, ya, dan digital asset and crypto. So the digital asset and crypto will be coming to OJK in by January 2025. Yeah. Okay. Let me start with the big picture about financial industry. But maybe on the macro, I think you know that Fed fund rate is not coming down yet. Yeah, Fed fund rate now is about 5.5%. And Indonesia central bank rate is 5.75. So maybe this is the first time in Indonesia history that only different di sini. I saw also Pak Anton Gunawan is another senior economist here. 25 basis point only. Central bank rate and Fed fund rate. Usually perbedaannya about maybe 1.5%. So this is today we able to manage only different 25 basis point. Yeah. Why? First, because our trade balance surplus, because the fiscal situations is very healthy. The fiscal deficit this year target is only 2.3% of GDP. Could be lower than that, yeah, the realizations. Yeah, but if you look the forecast of international economies, they make forecast that the 2024 Fed fund rate is coming down. So hopefully by that time Indonesia also able to cut rate. Hopefully we able to manage our current accounts, export-import goods and services still in the healthy level. Okay, on the financial industry, we look on in the capital markets. Capital markets in terms of industry, we have mutual funds industry year to date increase a little bit. Year to date is 1.2%. Total mutual fund plus KPD, RDPT, EBA dan sebagainya, total is about 844 trillion rupiah. This is growth 2% year to date. Jumlah investor retail is about 11.5 million people. Compared to 2021, retail investor is at 7.4 millions. In terms of value of capital raise, year to date until August 2023, 172 trillion rupiah. 172 trillion rupiah. Number of IPO 58. Right issue 19, efek surat efek utang ada 9 dan lainnya ada 62, total 148. Okay, if you look the banking sector, this is the largest sector in the in financial industry. So total credit in Indonesia is about 6,700 trillion rupiah. Year on year credit is about 8.5% as of July. Year to date is about 4.1%. Yeah. 8.5% is actually slightly lower compared to when everybody economists make forecast at the beginning of the year. Because beginning of the year, industry or economists forecast the banking sector grew maybe 10-12%. The year on year up to July is 8.5%. Year to date is 4.1%. But the banking sector is very healthy in terms of capital adequacy ratio is 27%, 27.4%. The credit rest through COVID, July is 339 trillion, sudah came down. Last year July was 560 trillions. In terms of non-performing loans, gross, last year July was 2.9%. July this year 2.5%. And loan at risk is basically NPL plus special mention loans plus rest-through loans. July last year was 16.8% and July this year is 12.6%. Liquidity is still very ample in the banking sectors. Yeah, as you probably follow that during the COVID 2020 to 2022, central bank was allowed to buy government bonds in the primary markets. So meaning there is a liquidity coming from central bank directly coming to the system. So this helped liquidity a lot in the system. So the asset liquid to total deposit, the liquid asset to total deposit, minimum is 10%. Currently is 26.5%. So liquid asset to total deposit, minimum is 10%. Currently is 26.5%. So liquidity is still very ample in the system, in the banking sectors. I think my fellow economists that follow the monetary or the banking sectors, during the booming, during the tight liquidity, usually the deposit rate was above central bank rate. Pak Fauzi also economist. Yeah, during tight liquidity, during booming era, deposit rate usually above central bank rate, maybe 100 basis points. But now average deposit rate is only about 4.3, 4.4%. Central bank rate 5.75%. So if people say only tight liquidity, just compare central bank rate with the deposit rate on the average. Of course, maybe there are some banks that offering deposit rate above central bank rate, but on average, the deposit rate now is still maybe 150 basis point below central bank rate. Okay, so we coming to the insurance industry. So insurance industry in terms of premi, July cumulative is 177 trillion as of July. Growth negative 2.3%. Insurance premi cumulative July negative 2.3%. Why? Of the 177 trillion, 102 trillions came from life insurance premi. The life insurance premi growth negative 7.8%. Even though the general insurance and reinsurance premi 75 trillion rupiah growth 6.3% positive. So which industry that made the insurance premi negative growth is the life insurance industry. Why? I think a lot of players from insurance industry here. Yeah. I think this is still a story about unit link. So OJK in 2022 issued stricter regulation in unit link. OJK consumer protections under Bu Kiki also issued stricter regulation in the consumer protections, yeah, including in the market conduct, yeah, also market conduct, also including for the insurance company, yeah. But we believe, yeah, that the industry learning about this, yeah. So I heard, yeah, several new products issued by the industry, customer learning, yeah. So we believe that this is just a consolidation period for the life insurance industry. To the better, yeah. So don't be pessimistic, because you know, with the insurance to penetration of insurance in Indonesia is only 2.3% of GDP, yeah, compared to Thailand 4.6%, compared to Singapore 12.5%. And the characteristic of developed country, penetration of insurance is much higher than this. Yeah, if you look, Malaysia is 3.8, Thailand is 4.6, and Indonesia half of it. So, meaning still a lot of potential, yeah. So the homework is how to have a product that fit with the public, with the customer, how the regulator also to support the development of the industry. So the Undang-Undang P2SK, the Omnibus Law, actually give a new mandate to OJK, to Bank Indonesia, to Minister of Finance. Kalau sebelumnya mengatur, mengawasi, melindungi. Undang-Undang P2SK menambah add one word tentang mengembangkan. Makanya Pak Adi namanya undang-undangnya kan pengembangan dan penguatan, ya. Yeah. So I said to my friend at OJK, so don't forget that we have a new mandate, not only to regulate, to supervise, to protect customer, but we have to develop. You have to develop. Yeah. If we look in terms of the healthiness of the insurance industry, we have RBC of 460.3% as of July, way above the minimum, yeah, way above the minimum. This is for the life insurance, and for the general insurance and reinsurance, the RBC is 311%, also above the minimum. Yeah. If we look on the literacy and inclusions, banking sectors inclusions about 74% and literacy 49%. This is the sectors this is the largest sectors in Indonesia financial sectors. So I think majority people in Indonesia know already about banking. Yeah. So that's it's not a surprise that the inclusion is 74% and literacy is about 49%. But insurance, literacy is higher than inclusion. Literacy is about 31%. Inclusion for insurance only 16% compared to banking sector, inclusion about 74%. And pension fund is even lower. Yeah, so inclusion for pension fund is only 5.4% compared to insurance 16% and banking sector 74%. And so meaning that still not only the job of OJK to do the educations, so we ask the industry, we work together, the media, the associations, we have to increase the educations to the public, to the society about insurance and also about pensions. So what is the challenge on this industry, insurance and pensions, including the guarantee? So in OJK, previously before January 2023, we call it bidang IKNB. Now bidangnya Pak Ogi, we call it bidang PPDP. Another singkatan. PPDP itu apa ya Bu? Perasuransian, penjaminan, dana pensiun. Jadi perspektif konsumen, literasi keuangan terkait manfaat dan risiko produk layanan sektor. Nah ini hasil dari survei. Konsumen perspektif perlu literasi terkait manfaat dan risiko produk layanan sektor insurance dan pension fund. Penerapan prinsip-prinsip perlindungan konsumen. So maybe for Bapak Ibu yang dari industri atau dari para peserta, the status dari komisioner perlindungan konsumen, edukasi dan perlindungan konsumen itu ada berubah. Sebelumnya tidak disebut kepala eksekutif. Undang-undang P2SK itu sekarang menyebut edukasi dan perlindungan konsumen itu menjadi kepala eksekutif. Sama seperti kepala eksekutif perbankan, kepala eksekutif asuransi, kepala eksekutif pembiayaan, kepala eksekutif pasar modal. Artinya perlindungan konsumen itu sekarang menjadi setara. So if Bapak Ibu menawarkan produk insurance, produk pension funds, product of capital markets, banking product, don't forget to balance between offering product, the commercial side, and offering product, the consumer protection side. And we are serious about this. We are doing the So the OJK PPDP, tempatnya Pak Ogi, itu bikin presentasi judulnya Industrial Reform. Ya, to send message to the industry that OJK wants to the reform for internal OJK and also to the industry. Industrial reform. Kebutuhan permodalan ya akan diperkuat. The capital. Quality of governance and risk management diperkuat. So if you follow beberapa regulasi yang terbit dan akan terbit dari OJK, ya, ada penguatan governance di banking sector. Penguatan governance di banking sector itu termasuk di bank umum, termasuk juga di BPR, penguatan governance di capital markets, governance and risk management, di insurance, di pension funds, nanti menyusul di lembaga pembiayaan, kewajiban sertifikasi, ya, kewajiban sertifikasi, kewajiban ada untuk lakukan pelatihan, training untuk internal. Previously, banking sector already done this long time ago. There is a specific percentage of the human resource cost have to go to pelatihan pengembangan pegawai. Nanti ada buat BPR, ada buat insurance, ada buat lembaga pembiayaan, ya. Karena sebelumnya kalau ditanya kenapa nggak lakukan pelatihan, selalu terus kemudian baliknya nggak diatur. Kalau nggak diatur ngapain buat pendidikan? Aneh juga ya, kok perlu harus diatur untuk mendidik karyawannya sendiri. Akhirnya dibuatlah aturannya, semuanya minta diatur. Ya, mohon maaf nih, saya ini emang stylenya begini kalau ngomong. Pemenuhan kebutuhan expert, khususnya di bidang aktuaria, ahli investment analysis, dan IT. Ya, we know about the risk of IT, everybody knows. Ya, cyberware dan sebagainya. Aktuaria sekarang dimonitor pemenuhannya, ya. Tentu termasuk aktuaria untuk internal OJK juga. So tadi kan saya bilang, we do in reform not only to the industry, OJK-nya juga harus doing reform. Ya. Investment analysis. Pension fund invest in the capital market. Insurance invest in the capital market. Ya, teman-teman yang di asuransi, yang di insurance harus paham tentang the risk of capital markets. Ya. Data terintegrasi di OJK. Sekarang kami perkuat. Karena mandat OJK adalah terintegrasi. So now, the supervisor in the insurance, supervisors in the pensions, they can monitor, yeah, on the regular basis about investment of the insurance company, of the pension funds, the investment especially in the capital markets. Yeah. Mutasi internal dilakukan di dalam OJK supaya yang mengawasi asuransi tahu capital market, yang mengawasi capital market tahu tentang asuransi, ya, internal mutasi dilakukan di dalam internal OJK. alokasi sumber daya, pengawasan dan secara efektif dan efisien. Prioritas OJK 5 tahun ke depan terkait bidang ini, tentu ya tadi Bapak lihat ada RBC yang sangat baik, tapi kita tentu tahu masih ada yang sakit, so we have to deal with it. Ya, kita harus menyelesaikan. Ya. 5 years from now we will have penjaminan untuk asuransi. Sebelum penjaminan untuk asuransi itu ada, OJK harus membereskan ya perusahaan-perusahaan yang saat ini belum sehat. Banyak aturan-aturan turunan dari P2SK yang harus dibuat tahun 2023-2024. Dan tadi ya salah satu that's already mentioned by Bu Nelly dan tadi oleh Pak Sua, that ya terkait PSAK, IFRS yang sekarang sudah ada task force-nya, ya penyiapan bahwa industri implementasi of this IFRS dan PSAK ini harus bisa terlaksana dengan baik. Ya. So I think I have to stop here. Yeah, but the message is yes, the industry is very, very important. As I mentioned, that the insurance and pension funds, if we look the developed countries, these two sectors contribute to finance the development of country. While in Indonesia, insurance and pension fund still very small. So we have to work together how to develop product, yeah, to educate, develop product, but also don't forget to protect the consumers and the public. So thank you very much for having this seminar to the IFG and IFG Progress. Yeah, thank you. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you Pak Mirza. Kindly remain on stage. Pak Mirza harap tetap ada di atas panggung. We're going to proceed to the opening ceremony once again. I would like to invite Bapak Mirza and also the Vice President Director of Indonesia Financial Group, Bapak Haru Kusmahargyo, Deputy for Finance and Risk Management, Ministry of State-Owned Enterprises of the Republic of Indonesia, Ibu Nawal Nelly, and the Chairman of Board of Commissioner Indonesia Financial Group, Bapak Fauzi Ihsan. Please take place behind the podium. We are going to start the opening ceremony of IFFG International Conference 2023. So the usher will pass the triangle to all of distinguished guests, and we are going to proceed it together on my count. We will start the procession by put the triangle on the podium together, and on my count, please wait. Okay. Okay, before we put the triangle to the podium, could you please show the triangle to the audience right here before we start to put the triangle on the podium together? All right, on my count, I think everyone is ready. We are going to start in 3, 2, 1. Please place the triangle into the podium. Silahkan diletakkan triangle-nya di podium, Bapak Ibu. Give a big round of applause. IFG International Conference 2023 are officially begin. Please move forward. Ladies and gentlemen, we are going to have a photo session. We're going to take pictures together as a part of the opening ceremony. And to all media partners, please take your place to have a best pictures to mark the opening of Indonesia Financial Group International Conference 2023. Once again, give a big round of applause for the opening of Indonesia Financial Group International Conference 2023. Thank you, ladies and gentlemen. Thank you, Bapak Mirza. Thank you, Bapak Harukus Mahargyo. Thank you to Ibu Nawal Nelly. And thank you to Bapak Fauzi Iksan. Thank you to open the ceremony of IFG International Conference 2023. Distinguished guests, ladies and gentlemen, finally, this is wrap up our opening ceremony. We kindly request you to remain on your seats as we continue to our first session, focus on navigating global stagflation and financial sector headwinds in a few minutes. Ladies and gentlemen, we kindly request that you remain in this room as we prepare to commence our first session shortly. And once again, your patience and cooperation are highly appreciated. Thank you.
The financial sector plays a fundamental role in the economy of Indonesia, one of which is to be the source of financing to support Indonesia's ambition and aspiration of becoming one of the top 5 largest economies in the world by 2045. By then, the nominal GDP of Indonesia is expected to reach more than $7 trillion, with GDP per capita increasing to 5 to 6 times greater than its current position. To finance such a large project, the role of the financial sector needs to be broad-based and balanced at the same time. However, when examined from the current conditions, Indonesia's financial sector is still relatively underdeveloped. In 2020, Indonesia's total financial sector assets are still around 115% of the nominal GDP, while the average of developed economies' financial sector at least around 300% of the country's nominal GDP. A well-balanced development of the banking and the non-bank financial sectors is a common feature of a developed country's financial sector. The financial asset structure of Indonesia currently is still very much concentrated around the banking sector and the capital market. Meanwhile, the non-bank financial institution sector, especially insurance and pension fund, is still very small in terms of the asset size. Therefore, a rapid and sustainable growth of the insurance and the pension fund sector is going to be a major agenda of the financial sector development of Indonesia in the next 2 decades. Insurance and pension funds are among the largest investors in the financial market, allocating a significant portion of their assets to capital market instruments, typically around 80% of their total assets. Economic downturns can indeed impact their investment returns, which in turn can affect their ability to fulfill policyholder obligations. So the role of investment strategy, risk management, and good corporate governance are among the essential traits in the overall development of a prudent, competitive, and sustainable insurance and pension fund ecosystem in Indonesia. However, the insurance penetration and the financial inclusion rates index of Indonesia are still relatively low in comparison to the ASEAN 5 countries. The low penetration and inclusion rates in Indonesia are also confirmed by the literacy survey conducted by IFG Progress. In general, the survey found that insurance literacy at the university level in Indonesia can be classified as moderate. Furthermore, when viewed based on the dimensions of literacy, most respondents are still moderately literate in the understanding dimension and are classified as quite low in literacy for the knowledge dimension. As a strategic state-owned holding company in the sector of insurance, underwriting, and investment services, Indonesia Financial Group, or IFG, through its think tank IFG Progress, present the second annual IFG International Conference aims to cement further the commitment of the Indonesian Financial Group, or IFG, to provide platform for policymakers, industrial players, and other relevant parties to discuss and debate current and future challenges facing the development of the insurance and pension fund in Indonesia. As for the first IFG International Conference, the discussions in the second annual IFG Flagship International Conference will start with an update of the ever-changing global economic and financial landscapes. For the pension fund, the focus will be on the liability-driven investment strategy. The conference will then touch upon several immediate and structural challenges facing the insurance industry, from the implementation of the IFRS 17 and the vast opportunities awaiting the micro-insurance and Sharia insurance sectors. The conference ends with a special session debating issues surrounding the adoption of the insurance guarantee scheme in Indonesia as stipulated under the newly passed bill on the development and strengthening of the financial sector.
Ladies and gentlemen, our first session of Indonesia Financial Group International Conference 2023 will begin shortly. Please be seated. Once again, ladies and gentlemen, and all distinguished guests, we're about to start our first session of Indonesia Financial Group International Conference 2023. Please be seated. Thank you. Ladies and gentlemen, We're about to start our first session of Indonesia Financial Group International Conference 2023. Please be seated. Once again, ladies and gentlemen, please take your seats as we will begin our first session of Indonesia Financial Group International Conference 2023. Thank you. To all distinguished guests, ladies and gentlemen, please proceed to the main ballroom as we begin our first session of Indonesia Financial Group International Conference 2023. You also can bring your beverages and also your snacks into the ballroom, and please be seated. Once again, ladies and gentlemen, please proceed to the main ballroom and take your seats as we will begin our event shortly. And also you can take your snacks and your beverages into the ballroom. And we will about to start the Indonesia Financial Group International Conference 2023, the first session. Thank you. To all of our distinguished guests, ladies and gentlemen, please proceed to the main ballroom and take your seats as we will begin our event shortly. We will start our first session at Indonesia Financial Group International Conference 2023. You can also bring your snacks and your beverages into the ballroom. Once again, distinguished guests, ladies and gentlemen, please proceed to the main ballroom. We're about to start our first session of Indonesia Financial Group International Conference 2023. In regards, you can also bring your beverages and your snacks into the ballroom. Thank you. Distinguished guests, ladies and gentlemen, please proceed to the main ballroom and take your seats as we will begin our event shortly. Once again, distinguished guests, ladies and gentlemen, please kindly take your seats and proceed to the main ballroom. We're about to start our first session of Indonesia Financial Group International Conference 2023. On that regard, you can also bring your snacks and also your drinks into the ballroom. Thank you. Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera, Om Swastiastu, Nama Budaya, Salam Kebajikan. Good morning and welcome back, distinguished guests, ladies and gentlemen, and welcome to the first session of IFG International Conference 2023. As we transition to our first session, I would like to inform you that there will be a question and answer session. Therefore, we provide a QR code to submit your question. Please kindly scan the QR code shown on the screen, or it is provided on your table. But also, you can ask the question directly through the moderator while the Q&A session going on. And once you scan the QR code, you will be able to submit to your question. Once again, you can ask directly to the intended speakers through a moderator that will conduct our session later on. So distinguished guests, ladies and gentlemen, the first session of the 2023 IFG International will focus on navigating global stagflation and financial sector headwinds. We will be discussing and debating updates on the microeconomic and financial landscapes of the global and regional economies and the Indonesian economy. It will also aim at identifying potential bearings of this macroeconomic environments on the insurance sector in general. And once again, ladies and gentlemen, distinguished guests, thank you for your presence and dedication and efforts to overcome global stagflation and financial sector headwinds. Let's make this forum a platform for actionable insight and meaningful connection. Before we begin our first session, I would like to invite our moderator, and I'm going to give you some introduction about our moderator for this session. So our moderator got his PhD degree in a Doctor of Philosophy and also Master of Arts in Economics from Brown University. Please welcome our moderator for this section on Indonesia Financial Group International Conference 2023, the head of IFG Progress Indonesia Financial Group, Bapak Reza Yamora Siregar. The floor is yours.
Good morning, everyone. Assalamualaikum warahmatullahi wabarakatuh. Before I call the participants and the panelists of my sessions to come to the stage, allow me please to give a bit of motivations on what these sessions will be. Our sessions number one is on the macro outlook. So we're looking at navigating global stagflation and financial sector. Let me start with the following. So one of the things that we learned in the last couple of years, especially, of course, is managing the linkages between what happens in our microeconomic side, both domestic macro and external macro, and our own financial economy sector, is a key feature of an economic system that will be able to maximize the multiplier effects, both from the policy side and also from the rest of the economic agents. This has been the challenge. Ability for the financial sector to not only channels, like what Pak Mirza and Pak Sua indicated in the morning, resources across different economic sectors, and also as an absorber, so not only channeling, but also as a absorber to both domestic and external sector shocks are critical. And managing it in the last few years has been even more difficult. Yeah. We have been facing a lot of challenges. We have seen a number of what we call black swan events. These events that are taking place only very rare time. For instance, when you look at the pandemic that we had in 2019, the last time that happened was 100 years ago. Now, what was unfortunate in the last few years, we have one pandemic, one black swan event, which was then followed by another one, what is known as stagflations. That the last time stagflation took place was about 40 years ago, when we had to deal with OPEC 1 and OPEC 2, when you have a crisis in the oil price. So in recent months, we have seen, or we are actually very concerned on the issue of global prices and the response of central banks around the world. We are very concerned about not only the response, but the fragmentations of the reforms. I think Pak Suwa mentioned this morning that the Minister of Finance did not expect, or does not expect at this stage, that the elevated inflations and therefore the interest rate of the global economy will likely to go down anytime soon. Now, the issue of this, if you go back to the COVID period, the questions that we discussed a lot was, how do we exit from this expansionary low interest rate environment? We were talking about how do we orderly exit. Okay? What we do not know at that time was that we had to go an abrupt exit, where moving from expansionary, we move into a sudden tightening, where the US was actually moving from about 25 basis point of interest rate all the way to 5.525, so about 500 basis point in less than 2 years. And this has resulted in a number of weak in the sentiment in the market and even call for recessions. Now, for us in the financial sectors, this has been the challenge, because any of those shocks will either impact our GDP, our inflations, our interest rate, I could name also our exchange rate here, and that will fit into our asset quality, fit into our liabilities, fit into our minimum risk-based capital requirement, and at the end of the day, they all go down to our solvency, our risk-based capital. So understanding the global phenomena, the global macro, are a must for us, even when we are doing into a very micro insurance and pension fund business. It's no longer enough for us to just talk about what we need infrastructure-wise in our insurance and pension. We need to look at into the global. For that, this session's number one is what it is for. So I'm very happy and excited to welcome a number of my colleagues here. Let me start with Pak Wael Mansur, Senior Economist from the World Bank. Can you join me on the stage, Pak? Pak Wael has come with a numerous experience from different parts of the world, from East Asia, West Africa, and Middle East. I asked Pak Wael to give me a bit of perspective, to give us a bit of perspective from the global economy. So what happens to the global economic conditions and also the financial conditions. The next speakers, can I ask Mr. Anthony Tan, please, to come join me on the board. I know Anthony since 2011. We were together at the ASEAN Plus 3 Macroeconomic Research Office in Singapore. The focus of ASEAN Plus 3 Macroeconomic Research Office, or we call it AMRO, is actually looking at regional surveillance, regional economic surveillance. So I will ask Anthony to share a bit of light on their findings and their views on the regional economy. Last but not least, it is a great pleasure for me to invite my colleague Pak Raden Pardede. I don't think he needs any more introductions. He is our most senior economist at the Kemenko Economy, at the Coordinating Minister for Economic Affairs. He's been advising multiple ministers of Coordinating Economic Affairs since 2014. He has both financial and real sector exposure. And you will hear directly from the mouth himself, what he thinks about the Indonesian economy. So we'll start with the global, we go into the regional outlook, and then we talk about the Indonesian outlook. And hopefully that will propel us into discussions on the rest of today and tomorrow on insurance and pension fund. So without further ado, let me ask Pak Wael. You have 20 minutes, sir. Thank you.
All right. Thank you very much. Are we going to show the... So thank you very much for the organizers for inviting me. It's very challenging to speak after the very enticing and exciting opening session, and it's always humbling to speak with such a distinguished panel. So thank you for the invite. What I'll try to communicate today is the selection of the word navigating the global economy. And I think the organizers have selected the word navigating very proper to the situation of the global economy, because we're really living in a very challenging, uncertain, and turbulent environment. So what I'll try to do in my presentation is to look at a little bit what are the near-term prospects of this global economy, what are the long-term prospects and challenges to the global economy, and third, focus a little bit on some policy priorities for policymakers at the global level, and some food for thought that obviously we will expand in the speakers when we talk about the region and Indonesia specific. I would have to say that a lot of the details of this presentation is actually taken from the World Bank's Global Economic Prospects that was published last June. So let me first start with the near-term prospects. After suffering from the COVID pandemic, which was really one of the worst global slowdowns after World War II, the original thinking that the economy will be recovering, pent-up demand was going up, and the world was actually getting back on its feet. However, given many global tensions, the global growth suddenly decelerated, and the deceleration was mostly pronounced in the advanced economies. Not only that, this deceleration in the advanced economies was actually trickled to emerging markets, and in the first half of the 2020s was the weakest half in terms of growth of any decade in the past 30 years. And the drag on growth was really related to inflationary pressures that started, if you want, with the global tension after the Russia invasion of Ukraine. That was followed by monetary tightening, one of the toughest tightening that occurred in the past decades, and my esteemed colleague has showed some of the figures, but what it meant is that borrowing costs suddenly shot up and became very expensive for both households and for firms globally. And we've seen, given these rising borrowing costs and given the slowdown in demand, we have seen a subdued external demand, which has really affected emerging markets' exports. Whether it's the commodity exporters and the nominal commodity exporters. Some of the commodity exporters have had tailwinds from rising commodity prices, but given the slowdown in global demand, that has affected a little bit some of the quantities they export. So what we're projecting is that the global economy will really slow down in 2023. It will pick up a little bit in 2024 ahead of some of the positive numbers that are coming from the labor market in the US. And that's why we see that advanced economies on average will be growing. Emerging markets, less so. And if you take out some of the China recovery effect, the situation becomes a bit more challenging. And obviously, this is a broad paintbrush. Every country-specific, region-specific will be different. But overall, we're expecting that growth will remain subdued in the near future. Now, within this growth prospects, there are a multitude of downside risks that are really to a great extent, they are interlinked and intertwined. We've identified 9 of them. Financial stress, obviously we have seen, given the rise in interest rates, how some of the banks in the US, in Europe, were forced to, had liquidity problems and authorities had to intervene. And this had some trickling effects. Further monetary tightening, which to rein in global inflation. And as we said, these are the period of low interest rates is now gone, and we estimate that this is a risk to the global economy because of those rising borrowing costs. Persistent high inflation that is not only coming despite this slowdown in domestic demand, and despite some slowdown in commodity prices. However, the multitude of shocks that we have seen, whether it's geopolitical, whether it's related to the harvest or to El Nino, for example, means that inflation is still very much sticky, and that poses a big downside risks to growth. Geopolitical stress is number 4. And here we're talking not only about political shocks like Russia's invasion of the Ukraine or wars that have occurred or tensions that have occurred in Africa and everywhere, but also a growing number of restrictions on trade. And this links to my 5th point, which is the fragmentation of global economic network, because we've seen actually a shift in global consumption towards less trade-intensive goods and more services. But also we've seen a lot of countries taking restrictive trade measures and more inward-looking policy. And this is across the board. Advanced economies, emerging markets, low-income countries, which have really disrupted a kind of easiness of trade flow, which in our earlier estimate, we thought that this would be going well, given that, shipping costs and shipping constraints that existed in the pandemic were coming back. Also, energy and food insecurity. We've seen prices of staple goods like rice, like wheat, remain very high, creating social tensions in a lot of countries. And we will never forget also the climate-related disasters, whether what we've seen in Libya in terms of flood, what we've seen most recently, but across the world, we've seen floods, we've seen fires, and those all are related to the very important climate agenda, which is becoming a risk to the global economy. I'll talk more about the weaker long-term growth prospects, which is basically the decline in productivity. Now, let me focus a little bit on global inflation. median inflation is around 7.2%, which is a very high inflation. And it is really eating up the purchasing power of a lot of the households. Basically also forcing many governments across the world to increase subsidy, which actually pushes the fiscal burden and reduces government potential to intervene to stimulate the economies going forward. Inflation is above target in most targeting economies. I know this is not the case in Indonesia, but across many of the advanced and emerging markets who uses inflation targeting, inflation remains above that, which means that monetary tightening is expected to continue, which translates into borrowing costs for firms that will remain high. Now, recent core inflation has been softening a little bit because of softening global demand, but there are always secondary round effects that makes this core inflation even more persistent. And the last graph that I wanted to show is actually if you look at the federal funds rate over different cycles of the economy, this is the highest cycle since the 80s. So we're really in uncharted territory. We cannot call it stagflation because we haven't seen that, but we are very much in a sticky inflation situation, high borrowing cost, and a slowing demand. Now, what I wanted to say on the US interest rate increase is that the more hawkish the Fed reaction is, the more adverse impact on emerging market. And we've seen that through the increase in the cost of government financing. We've seen that in EMBI spreads, which means that market is pricing emerging markets at a higher rate, and they're factoring in even a higher risk. And that's problematic for emerging markets who have seen also a lot of capital outflows, and some of these outflows are returning to advanced economies where the yields remain high. So so this US interest rate increase is problematic for emerging markets. We all remember the periods of taper tantrum, which had a particular impact on Indonesia. And we'll talk more about, I think my colleague will talk more about Indonesia, but there is really, policymakers are very concerned about these capital flows going up. And the second transmission channel is that, global financial stress, if it happens, could turn the global economy into a recession. If this financial stress that we've seen earlier in the year propagates globally to a much further degree, the world economy could fall into a recession in 2024. Hence the importance of, interventions by the central bank and regulatory authorities to coordinate globally, domestically, to keep those risks at bay. And we've run some simulations on what could be the effect. You could read all of this in the report. Now, what are really the long-term prospects and long-term challenges for the economy? And this is something that the bank is very much interested in diagnosing and having a dialogue with its client countries. We have seen that the potential growth has been declining in the past decades, and it is expected to continue declining. What is potential growth? Potential growth is actually, why is it important? Because this would dictate a little bit the level to which an economy could grow. And it's really, we've seen a declining trend, both in terms of slowing growth rates of labor force, of investment, and productivity. And this is across the world, across advanced economies, and across emerging markets. And the problem with that, especially when we look at emerging markets, is that if you exclude China, in our assessment, emerging markets and development economies are expected to make almost no progress at closing the gap in per capita income with advanced economy over the forecast period if those structural elements are not picked up. And we need this gap to close, not only in terms of, the implication it has, the social and welfare implication it has, but also for businesses to be able to have a demand side that is much higher. So what is required is really a decisive structural reforms, to improve 5 things. 1, improve the investment conditions. 2, develop human capital and infrastructure so that, this labor and capital growth picks up again to the levels they were there in the early 2000s. Increase the participation in formal labor force, and this is particularly a challenge for Indonesia. And foster productivity growth in the services sector. That's the importance of the deepening of the financial sector agenda, the financial sector omnibus law, the reforms that are related to services with all the digital agenda linked to it. And 5 is promote international trade and reduce some of the restrictness there. The second challenge on the long term is really linked to the fiscal challenge. This is particularly the case, while I label it in this form a challenge for low-income countries, but it is a global problem, because the bank has been warning of an upcoming global crisis, global debt crisis. Government debt has been increasing significantly. I mean, it has almost doubled in low-income countries, increased significantly in lower middle-income countries, and this poses a problem not only to this category of countries, but also to advanced economies, to creditors, who has to be part of the solution. And having high levels of debt means that also the level of interest payment is not getting down. We've talked about borrowing costs going up, which means for these countries that are in a bad fiscal situation to start with, will suffer greatly to allow for a fiscal space and invest in their development. And this would create all sorts of challenges to the global growth. And all of these countries have structural fiscal challenges: low revenue, low tax revenue collection, high spending on recurrent spending like wages, subsidies, etc., and low capacity to do public investment. So the fiscal challenge is also a long-term structural challenge to global growth. I'm conscious I have 2 minutes, so I'll go quickly to the third question. So what are really the policy priorities going forward from a global perspective? There's a lot of nuances by country and by regions that my colleagues will talk about. So first, there are a set of policy priorities that ensures macroeconomic stability. And this includes more coordination globally. Central bank's credibility is really at the center of particular importance to kind of mitigate the monetary and financial policy challenges. And then the third, a careful review of the fiscal policy that is there. Try to create more domestic revenue mobilization and channel those additional fiscal space into productive, pro-growth, pro-poor investments. So macroeconomic stability is one. And then really working on the structural element to boost growth and resilience in the long term, whether it's the digitalization, reducing trade costs, whether invest in information and technology infrastructure, whether boosting foreign direct investments across the world, opening up sector to capital flows, or strengthening really the giving a particular attention to social inclusion in order to avoid political tension. So I'll stop here just to say that it is a very challenging global environment, and policymakers are really I don't envy their position in taking decision. You can read all of our prospects on the global economy at our websites or on Indonesia's economy as well. Thank you very much.
Thank you very much, Mr. Wael Mansur. Thank you for the times also. Okay, without further ado, let's just finish all the speaker before we come to the Q&A. Anthony, can you help us with the regional outlook, please?
Okay, thank you very much. A very good morning, ladies and gentlemen. On behalf of Emerald, let me thank the IFG Group for the kind invitation for me to participate in today's conference. It's truly happy to be back in Jakarta and seeing some familiar faces. Today, my presentation will be on the regional economy. In fact, I'm very pleased to share with you our assessment on the regional economy. My presentation will focus on the recent economic developments, looking at the recent economic and financial trends, followed by the risks and challenges, and of course, the outlook ahead. Okay. First, on the global macroeconomic backdrop, I will not touch in detail as Mansur has already touched upon it, but I'd just like to make the point that if you look at the global macro backdrop, I think we are very fortunate that the global economy turns out much better. Right, the global economy is performing much better than anticipated when 2023 began. In fact, 8 months ago, we in Emerald, as a surveillance organization, we are very worried. In fact, thinking about the worst because things are not panning out that well. But thankfully, the global economy, demonstrated remarkable resilience to the string of, shocks after shocks, and that is something that is, we should be thankful. And indeed, if you look at this chart, the global economy, particularly the US, it's still growing amid the rapid disinflation. So we are not seeing, stagflation yet because growth is still holding up. And for next year, we are still seeing growth to remain positive but subdued around 1% level. And this is good for the regional economy. Of course, I think what perhaps is the more concerning of late is the developments in China. As you can see on this chart, contrary to expectations, the economic recovery in China has not been as strong as expected. In fact, early of the year, I think most analysts and most certainly most economists expected a very sharp rebound in activities when COVID restrictions were lifted. And this is looking at historical performance in other ASEAN economies, right? Where they open up, things really rebounded sharply. But unfortunately, this hasn't happened yet in China. In fact, we expected, this notion of revenge spending kicking in very strongly because of these, strict zero COVID restrictions. So we are expecting a lot of this pent-up consumption demand to be released. So clearly, after the initial burst of activities, right, things have basically run its course, right? The strong growth has in fact run its course. And in recent indicators, if you look at the PMI indicators, these are monthly indicators, they are not looking particularly great. this chart on the far left shows that it is, picking up gradually, but at a very, very modest pace. And this has got to do with two factors. Contrary to expectations, we can see that the middle chart, there's a lot of build-up of excess savings by the general households. So they have not, draw down on the savings yet. That is why we are not seeing the kind of pickup in auto purchases, durable good consumption by households. So we are not seeing that. These are big ticket items. What we are seeing them doing is, they are doing a lot of eating out, doing recreational activities, but this will not really drive the economic forward, right? Because for the region, we are looking forward to these positive spillovers. That means we are wanting to see more Chinese consuming more durables, and that is important for our exports, right, for the region. And the second thing is, of course, the property sector is in the downturn for many years now, and that is really holding back the confidence. So people are not very confident about their job prospects. That is why they are not, unfortunately, consuming what we would like them to do, right? So these two are the kind of headwinds that are confronting the Chinese economy. Now, turning to Japan, in contrast, we are seeing activities has been pretty robust and I would say sustained so far. Real GDP growth, you can see, is doing very well in the second quarter, led by a lot of exports, autos, and also supported by inbound tourism. And of course, you have the weaker yen that's supporting the external trade. And of course, what is also very clear to us is that the headline inflation is actually rising. That's very clear. It's really trending upwards, as you can see on the middle chart. But what is not clear to us is that to what extent these gains in prices is transitory, right? Because what we know is most of it are driven by food, one-off electricity price hikes, and of course the weaker yen. So we are not sure to what extent such trend will be sustained. But what we know is that the labor market is pretty tight. The chart on the far right. You can see that the indicators there. So it supports the narrative that for this year and next year, Japan will grow slightly above the potential growth rate. Now turning to ASEAN. Encouragingly, we are seeing growth fairly resilient. Growth remains anchored by robust domestic demand, in particular private consumption. You can see on the chart, the red bars there is still doing pretty well. And that has helped to offset some of the sluggish trade, which you can see on the right chart. Exports are not doing very well, granting, understandably, the West is not consuming as much. So we don't expect that sector to be the key driver of growth for this region. Now, turning to inflation, I would like to echo what our Excellency, our Vice Minister Paswasil mentioned this morning. Inflation, although, you are seeing headline inflation coming up very sharply, but it still remains elevated. The headline inflation has fallen mainly due to energy prices, right? You can see in the middle chart, energy prices is the one indicated by red. But what is a bit of concern is that food prices remains still elevated. You can see the dotted line, dotted green line in the middle chart. It has not come down a lot. In fact, if you look at the indicators of major food commodities, particularly rice, they actually shot up quite a lot. And it is also a concern for us because if you look at the chart on the far right, most regional economies, they are basically net food importers. Yes, of course, demand for food like meat, dairy products, cereals, these are things that most ASEAN economies on net, they are importers. But Indonesia, I think it's pretty fortunate because overall it is a net exporter of food. But in terms of the critical products like cereals, meat, and dairy products, they are net food importers. Now, despite the easing of headline inflation, we see that core inflation remains sticky. I'd like to echo what our colleague from the World Bank, Mansur, also mentioned about this earlier. It's continued to be sticky. Core inflation is the one that is indicated by the blue line. As you can see that core inflation has not come down sharply as compared to the red line, which is the headline. And if you look at the historical past, at least in 2018, 19, yeah, it's still pretty elevated, and it's something of a concern, especially when a lot of regional economies, they're still struggling with cost of living crisis. And if you look at what drives the core inflation, this chart on the right, it's clearly the fact that it is basically due to sustained domestic demand. As you know, that countries are having their output gaps narrowing, and these are reflected in a lot of strong demand for things like housing, restaurants, hotels, and personal care or services. Now let me turn to the financial sector. Now, after a brief reprieve from the SPV shock, we can see that global financial conditions tightened again in August as stock markets came under renewed selling pressure. This is the indicator of a global financial conditions index for the US and Eurozone. So if you move downwards, that means it's tightening. And the chart on the right shows the selected stock market indices. Those are the S&P 500, Euro Stock, and for the region is MSCI, Asia Pacific, ex-Japan. And of course, you have another line, which is the gray line, sorry, the blue line, dotted line, which is the banking stocks in the US. Clearly, they have not recovered. And recent times, I guess the reason financial markets globally tighten is because I think markets were gripped by the fact that the latest data from the US is more positive than everyone expected. So there is this notion that markets fear that, as also alluded in the earlier sessions, the interest rate environment, the high for longer will dead and persist for some time. So it's unlikely that the Fed will cut interest rates. And also what Prime Minister has said, there's no particular reason for central bank to cut interest rate as well, because otherwise there will be unduly pressure on the exchange rate. And indeed, you can see this chart on the left, there has been a renewed weakening of regional currencies, because the dollar is so strong, and there's no compelling reason for the dollar index or the dollar to weaken, because I don't think the Fed is going to loosen interest rates even in 2024. So there is the risk that market expectations and what the Fed intends to do, so there could be some misalignment in expectations there, and if it's big enough, then there will be some kind of adjustment, and if hopefully it will not be a disorderly adjustment when the markets try to caught up with that Fed, what the Fed intends to do. Now, turning to the banks, I also agree with what has said during the earlier session, that banks in the region, they have ample liquidity, right? The chart on the left shows that, in most ASEAN Plus 3 economies, the liquidity coverage ratio is more than sufficient to cover the short-term obligations. And it's also assuring that if you look at the bank's rating and the bank's outlook distribution, the ratings outlook distributions, they have been pretty stable, right? The median rating is BBB+, according to S&P rating. And if you could look at this chart on the far right, the outlook distribution is mostly stable for the vast majority of the Asian banks. Okay. And it is also reassuring that, unlike what you've seen in the case of the SBV collapse, most banks in the regions, their source of funding are predominantly the bank deposits, and these are mostly retail deposits, which are pretty sticky, right? And within these retail deposits, the distribution or the allocation of this deposit, the sources of funding, they are pretty diversified, right? So we don't really feel there's a risk of a classic, bank runs when it comes to this part of the region. And also another encouraging note is that if you look at the securities holdings of banks in the region, they are mostly around 15 to just slightly below 30%. So the risk of banks having to realize mark-to-market losses because of rising interest rates will not probably be there because of, again, the notion of ample liquidity, which I alluded to earlier. Okay, and finally, let's look at the risks and challenges facing the region. This is what we call as the regional risk map. This is taken from our July quarterly update. We'll be releasing another update in 2 weeks' time, next month in October 4th. So this is what we have in July. So this is how we try to depict or try to illustrate schematically the risk facing the region, right? In terms of the likelihood on the vertical axis. On the horizontal axis, you have the imminence, and then the color of the bubble represents the impact, right? So at this moment, we are seeing, let me just take you through the 4 bubbles, which is what the risks are in a near term. Number one, if you look at the top left-hand corner, you have the financial spillovers from tight or tighter US monetary policy. And this is something that we are watchful because obviously, if the Fed stays pat on their interest rate trajectory, as in keeping it high for longer, somewhere along the road, something else will break, right? We have seen some of this materializing, SBB is one of them. So along the way, something else may break. So we are really watchful on some of this risk. And one of the areas is probably in the commercial real estate sector in the US. As we know, it's pretty leveraged and could be, some strains building up. So one example. And if you move to the bottom, if you look at the first bubble on the left, you have commodity prices. Yes, commodity prices have inched up gradually over the past couple of weeks because of Russia and production. So we are not seeing a very sharp spike up in commodity prices as what we have seen during the invasion of the Ukraine. So we are still keeping that at a low likelihood. And of course, the other risk that we're watching is China, definitely. We are starting to see some stabilization of activities in China, but I believe that personal reason is that if you look at the fundamentals, they are not looking very great. It's a question of whether they would like to have, or they would like to swallow the bitter pill now, instead of trying to kick the can down the road. As in some of the stabilization measures, policy measures, they are there temporarily to sort of shore up confidence. But clearly there are some fundamentals, distortions in the economy that they need to fix. And if they do it, and provided that, this journey or this adjustment period is smooth, otherwise it's going to be bumpy, and we do see some risk that the growth could falter in the short term. And turning to the to the bubble on the right is the recession in the US and Europe. We are not fully discounting this risk. Yes, the soft landing is a central view right now, a central scenario. But we are still watchful that this risk may materialize. That's why it is in red, right? It is a tail risk, right? Low likelihood, high impact event. So we are definitely watching that risk. And I think this is the last slide, is looking at the growth forecast for the ASEAN Plus 3. Overall, for the region, we are still expecting robust growth around mid 4% level this year and next. Mostly due to the plus 3 economies. China, at this moment, our forecast is still around low 5%, but I believe our China team is probably going to revise it downwards to near the target of 5%. And the consumer price inflation is of course coming down very sharply, but not sharp enough as compared to pre-pandemic levels. So these are our July forecasts. As I mentioned, we are going to revise this in 2 weeks' time. So you can see the numbers for China, right? It is 5.5, it's still on the high side. I suppose that our China team will revise it downwards to near 5%. And for Indonesia, we are not changing the numbers yet. It is still around 5% for this year and 5.3% for next year. Similarly, for inflation, we have also revised it downwards. Upwards for 2023. But if we exclude the two countries that causes much of the inflation to shoot up because of the depreciating of the local currencies, we have the revision downwards, the 3% and 2% for this year and next. Okay, in the interest of time, let me just stop here. This is just a recap of messages that I have presented. I'll be happy to take questions after this. Thank you so much.
Thank you, Anthony. Pak Raden, can you bring it home?
Thank you. I think it's good afternoon. It's already 12 o'clock, right? It's not good morning anymore. I'll present you the short-term outlook and long-term target and challenge that we face in Indonesia. Economists always have a sense of humor. When we talk about the economy, I've been, experienced so many up and down the economy. And for a long period of time, of course, we always say that the economy is uncertain, very challenging, turbulence, and that's what we call from time to time. So the business of economists always be trying to be pessimistic. Because basically we don't know about the future. That's why we try to be pessimistic. And if the economists make predictions that next year we will certainly have 5%, it's a good sense of humor. We don't know exactly whether it's 5% next year. And even some economists have prediction about the exchange rate 1,500 or 1,572 rupiah per dollar. It's amazing. We don't know about that. So I just start with I think my colleague already mentions a complicated and complex world that we face right now. This is a fragmented world, so complicated, so complex, and we don't know what it is, basically. Again, as I mentioned to you, that's a typical economist talk about the state of the economy that we face in the future. This is it. There's nothing new, basically. This is a Thucydides trap, which is the war between Athens and Sparta. That's precisely that we face now between US and China. With the hope, of course, in the past, the Thucydides trap between Athens and Sparta, which is, they have a war for 30 years, 40 years. With the hope, the war, which is the economic war or the technological war between China and US, we hope that it will not lasting for 30 years or 40 years. Certainly, we may not have a war in a sense just like what we see between Athens and Sparta. But we have seen right now, what we have seen right now is a technological war. This is economic wars, basically. So the competitions and conflict in terms of economics, I think will continue for some times in the future. I don't know whether 10 years, 15 years. Hopefully, it will last after 10 years, hopefully. And those guys have a different objective. This is why I mentioned about the fragmented world. Of course, Biden have his own objective. Xi Jinping have his own objective. Whereas Putin, as well as MBS here, have his own objective. See, some of them is political objective. And at the same time, I think as my colleague mentioned about Jerome Powell, he owns his own objective as well, which is try to curbing demand and try to curb the inflation rate. But basically what I'm trying to say here, each of these leaders have their own objective. And the way to achieve the objective is complicated, basically. And this is one of the things, I just taken this one from the ADB working paper, the impact of China to the world is quite significant. I think in the past we used to see the China growth double digit and then to 8%, now to 5%. And everybody mentioned over the next 10 years could be go to 4%, even to 3%. In a sense that China will be back to normal, just like a normal growth of the advanced country. For each 1% of China declining, the impact to the world is quite significant. This is based on the numbers from 2016 to 2020. And of course, we understand during the period, the contributions of China to the global growth is around 40 to 50% even. And this is quite significant. Look at the impact to the world GDP for each percentage decline of the China growth will be 0.42. And the impact to Indonesia is around 0.3%. The impact to the ASEAN countries is even bigger. Look at the numbers out there, right? The impact to Malaysia is minus 0.42, the Philippines minus 0.47, and then to Singapore also is quite significant. So if we see that China will continue to the downturn over the next, let's say, 1 decade, then the global economy certainly will decline. That's the trend of the global economy in the future. And of course, whether somebody else or other countries that can replace the contribution of China to the global world is remaining questionable. Whether India can replace China as a driver of the global world, I think it's still questionable. Now, Indonesia, whether Indonesia is resilient or not, this is, of course, the merah putih, you know that. Yeah. Yeah. I try to avoid the numbers, but so far so good. Yeah, most indicators show improvement. I think the Vice Minister of Finance already mentioned these ones, and similarly, Pak Miris already mentioned these ones. So I don't go to the detail about these numbers. We can discuss later about the detail of the numbers. So far so good. Yeah, in the short term, of course. And look at all of these ones. Don't look at the numbers. I don't think you can look. This is very small numbers. But just look at the color. If the color has become green, then basically the indicators is better. Yeah. So look at the numbers. Look at the color, basically. This is optimistic consumer confidence, even across income group. The inflation rate has begun to decelerate and consumer remain optimistic. Again, look at the numbers here, because the details, things you can see later on. Across all expenditure, across all income group, remain optimistic on current and future economic condition, I think 6 months in the future. So everything looks good. And similarly here, the investment leading indicators also remain robust. Again, just look at from the color itself. And at the same time, the risk perception toward Indonesia has been improving gradually. Look at, we start from 2010 to now. My colleague here already mentions basically, let's say, the yield of the sovereign bond in many other countries already increased recently. But in the case of Indonesia, relatively stable. But even during 2022 to 2023, when the interest rate hike in US, and yet the yield of the government bond, the cost of the government bond is basically relatively stable there. Very mild, the impact. And the CDS decline, the default risk falling, and similarly the spread between NDF and US dollar, rupiah, the risk premium also falling. So everything is good, yeah? But of course with some notes, especially I have to take notes on the left-hand side, especially the yield of the government bond. And that's the role of the insurance and pension funds become very important. Why we have to pay so much high compared to many other countries, even in the regions? We have to pay 7%, let's say around 7%, whether other countries pay only 3 to 4%. I think that's our homework here. That's the role of funding. And pension fund, insurance play a significant role and have to be responsible why our yield in SBN is quite high compared to many other countries. This is the Indonesian economy according to the IMF. Just look at this. GDP growth is around 5%, not bad at all over the next 2 years. Look at also the inflations is around 2.7%. Then you have also the current account. Of course, we have positive before, but now it's only 1% in 2025, which is quite low compared to the previous one, which is in 1915, we have the fragile, Indonesia is part of the fragile 5, because our current account deficit is more than 3%. And look at the projection of the government balance, the budget deficit is through 4.4%. In this year, until August, we still have a budget surplus. Until August this year. And the projection, I think, will be close to 1.5%, the budget deficit. So everything is good in the short term. But the challenge and risk, I think, remains. We cannot complacent. The trend of the global growth is continuing to weaken, as my colleague mentions. And we see a fragmented world. Geopolitics, the climate change, is become one of the biggest challenges that we face in Indonesia. And this is related to the inflations, and even food shortage is one of the biggest challenges, not only for economics, but also for social. El Nino problem. In addition to geopolitics and high interest rate that already discussed before, the El Nino phenomenon, until now, over the last 3 or 4 months, we haven't seen any rain. In Jakarta, but even in other parts of Indonesia. And that will continue. We don't know when will be end. Could be in January, could be in February. When the production is rise, problem, the inflation is also a real problem. But even I'm even more worried is not about the inflations, but when the rise is shortage, based on our experience in the past, that's become one of the source of the social problem. That's the biggest risk that I see in the near future. Hopefully, the climate will more friendly with us. So, despite we have seen these ones, of course, the recent challenge, I don't want to discuss these ones because my time is also limited. The impact toward inflation, job creation, and growth, I think remains a challenge for Indonesia. And this is again is quite similar to my colleague mentioned about the trend of the global growth is declining and weakening, and somehow related to the aging populations. The labor quantity contribution is declined, and similarly the capital contributions also decline. Look at that. When the global economic trend growth is weakening, at the same time we have this target. Indonesia emas. I think everybody already understands this. We'd like to achieve Indonesian economy or Indonesian people to become a rich country. You have to exit from this middle income trap by 2035 to 40, basically. And this is, of course, a very ambitious objective that we need to work out. So when we talk about this objective, then everybody have to work hard. And again, Pak Miris already mentions, what is the role of financial institutions on these themes? We need to transform the economy from low productivity to high productivity, from low value added to high value added. But at the same time, I think Pak Mirza mentioned about how do we finance these ones? We need the long-term funding for these ones. And clearly, our long-term funding, the basic of long-term funding is coming from your institutions, insurance, and also, of course, from pension fund, which is the contributions is only 2.3 or 2.57% of the GDP. Is way, way too small compared to Singapore 12%, more than 12%, and even Malaysia 3.8% and Thailand or 4.6%. So if we just do business as usual, I think we are going nowhere. We need to double the effort, to improve the contribution of the insurance sector to the economy. And again, how do we meet this challenge? I think I have discussed that to meet this challenge, then the transformation is the most important one. We need to transform the economy. If we exit from the middle income trap, if you want to go to the upper income group, there is no way we cannot be business as usual. We have to move up from low educated and low skilled population, from low wage to the high wage. We cannot continue low wage at the same time we will become Indonesia emas. That's not possible. From low productivity and low value-added productivity to high value-added productivity. From low technology content, which is most of our production still low technology content, to the high technology content. From declining investment growth to increase investment growth. From high ICOR, incremental capital to output ratio, to low ICOR. Because our ICOR now is around 6.7%. It's not efficient at all. We need to decline, we need to reduce to around 4.5%. So the key policies commitment, I think, is already there. I'm involved in also crafting some of this policy. But the main problem that we may face in the near future, which is up to the next government, is basically the implementations. How can we implement this new Transformations Act? Yeah, we talk about job creation law, financial sector law, healthcare law. It depends on the institution, whether institution is effective or not. So much to do. But again, I challenge you. I just take lessons from Rabindranath Tagore. You can't cross the sea merely by just standing and staring at the water. You have to swim. Thank you very much.
Thank you, Pak Raden. For you who doesn't know this, I happen to have the luxury of sharing office with Pak Raden at the Kemenko Economy. So if life with Pak Panto and Pak Hairo are not exciting enough, I can always drive across Jakarta to Lapangan Banteng and listen to what Raden views on the Indonesian economy. And you hear about some of this. So before I open Q&A, I want to remind you all again, please send me your questions. In this room, you can always stand up and share me your questions directly. But if you want, you can also use your QR code. I think there's information on the table of the code. You can send me, and I already have a number of interesting questions on my tablet here. But before I move into this, let me just summarize a few things, which I thought it was also a bit of confusing and contradicting. Yeah, I mean, one question that I have, I guess, to all of you also is, we are moving to digitalization, right? And I think Pak Mirza also mentioned, Pak Suha also mentioned about how, if I'm not mistaken, 4 economic reforms that Indonesia is looking at, one of them is digitalizations. And I think this is a global issue, right? And yet, I think Pak Raden and Pak Mansur highlighted that the productivity of global economy are likely to go down across the window of the next 10, 20 odd years. And which is for us is very critical. This is what we have left before 2040, before the aging population 2045. So questions that I have for Pak Weil and Pak Raden, I guess for Pak Weil in terms of the global and Pak Raden maybe on the Indonesian economy, you don't see that digitalization will help us with the productivities?
Thank you much. This is a very important and tricky question. Of course, digitalization contributes to lifting productivity. The problem is in which areas it is growing, right? It is often growing, for example, in the gig economy and creating low value added, as opposed to necessarily creating higher value added. And this is the problematic area. So digitalization has an aspect that is linked to good governance, to improved services, but how do you harness this into more productive sectors or productive function is the key. And one thing that helps is actually utilizing this digital revolution in firms becoming more competitive. When you have more competition, whether domestically or globally, you harness more the returns on this digital agenda.
Yeah. My feeling, we have to use this digitalization technology, and including, of course, artificial intelligence, as an opportunity for Indonesia to leapfrog. Digital technology and artificial intelligence is a short cycle technology. It's quite different with the process technology. Let's say the chemicals, yeah. This is a process technology, a long cycle technology. As soon as you innovate this process, I mean the chemical process, yeah, and then you can use it almost forever, 50 years. For example, our people, our friend in fertilizer industry, they continue to use the same process for more than 60 years. Yeah. But for digital, it's quite different. So I think this digital technology and artificial intelligence, we have to embrace these ones. We have to use these ones creatively, especially to increase the low value added of Indonesia. Because, let's say, in agriculture, if we injected this digital technology, the digital applications, we will increase significantly the productivity in this sector. And similarly, also for others, for SME, small and medium enterprise. So, but it is up to us, is basically. We need to take this one seriously, and this is the moment, the momentum, if I could say, this is the time for Indonesia can leapfrog to increase the productivity, just focus on the low value added activities in Indonesia, let's say agriculture, traditional manufacturing. Yeah, if we just injected this technology, I think the productivity will increase.
Terima kasih, Pak. Anthony, I just want one quick question, please, before I go to the floor. There's a number of highlights that highlighted and arguing that there's a lot of liquidity in the financial system. Yeah. But if you look at the case of China, deposito has picked up, lending has not. I think we have started seeing that evidence also in the case of Indonesia to some extent. Are you worried in Asia that we see liquidity, but not in the real sector, not where we need it the most? It only is actually parking in the financial market that could actually trigger additional costs to our financial system. Are you guys worried about that?
Yeah, thanks, Pak Reza, for the question. Yes, certainly it is a concern because what we are seeing that the banking sector, the financial sector, not just in Indonesia but across in ASEAN, is that there's ample liquidity, but the growth in lending to productive sectors, they are not that encouraging. As in, understandably, the banking sector is also somewhat cautious about lending, given what's happening in the global environment, because certainly banks are also worried about tightening liquidity standards, and on the part of the underwriters, they are also trying to have some safeguards in place. So it is still a very challenging situation to have this lending to the productive sectors. That is why in some regional economies, this is why the SME banks comes in. the provision of credit guarantees to SMEs coming by the government. Because obviously if you leave it to the markets, I don't think they can have the most efficient allocation of resources if it comes to this environment where everything is mostly uncertain and there's some risk aversion on the part of the banks. So there's some, I guess this is where there's a role for policy to come in to help, sort out some of these allocation of resources given this current environment. Thank you.
Thank you. I have few interesting questions on my tablets right now. But before I go into my tablet, is there anyone on the floor that wants to go directly asking questions to the panelists? Can you raise your hand, please, if anyone? Pak Ibra on the right-hand side.
Thank you very much, Pak Reza. My name is Ibrahim. I'm from Indonesia Financial Group, and my question is for Pak Well and Pak Raden. If we see the global rise has been increasing by almost 20% in August 2023, how will be the impact on Indonesian economy, especially in driving inflation? Because if we look at Susan's data, for instance, food is still about 50% of Indonesia's consumption, and rice in particular is probably about 10% of consumption by the household. And if you look at the comparison between western part and eastern part usually pays about 7% much more expensive in rice than the western part of Indonesia. So the question is, how do you see the future of macroeconomic stability, in particular inflation, when the rice crisis cannot be mitigated in the next short-term period, and especially the fact that for Indonesia it will be challenging due to the high density of rice in consumption? Thank you, Pak Reza.
Okay. The real great challenge for our inflation rate in the near future, it is true, rice is one thing, and the second one is basically, as I put the picture before, which is Putin and MBS is basically already cut the supply of the oil. The price of oil also will high. The combination of these two, I think, is quite significant to inflations in Indonesia. In terms of rice, of course, I mean, we understand the contribution of rice to the inflation rate also is quite high, could be around 10%. So if the price of rice increase, I think could have an impact, a significant impact to our inflation rate. But I'm more concerned is not the price itself, which is basically the availability of food even more important. Yeah, and of course right now, the government target is only 2 million tons of rice that are basically in our Bulog office right now. So we try to also have an access to many other countries, including China and India, with the hope that the impact of El Nino to India is less. Yeah? So we see a significant impact to the ASEAN countries, but less to India, and hopefully less to China. So right now, what the government can do is basically try to have additional supply from China and India. And of course, there is no such thing as a free lunch. So probably for India, we need to supply more the the palm oil. Yeah, we contribute the palm oil, and then with China, we need to do something else. So the impact again to the inflation rate, I'm not so concerned much, because the impact to all the food price all over the world will quite be the same basically. But I'm more concerned on the availability of the supply itself.
I think I just want to emphasize 2 points. One is that food is more dominant in the rice is more dominant in the food basket of poorer segments of society. So you creating a social tension or a social pressure. But then in terms of inflation, I think the risk is coming more from global oil prices. And we've actually revised upward our global assumptions on oil, and that would have implications. But then the question becomes, I think where Indonesia is good is that it has the fiscal space needed to intervene. Now, they've done so in the previous cycle of high commodity prices. I think they have enough fiscal buffers to intervene this time. Where the question becomes more structural is how do you get more domestic market integration so that these price differentials you've talked about between regions are subdued. And this is the whole agenda that is linked to logistics, shipping, etc. So this is more the structural element that requires policies and investments.
Thank you. I have a lot of questions more on the political flavor. So let me just keep the exciting one to the end. But let me just jump into one interesting question that I think all of you can help me answer. Are we committed in terms of energy transitions in the region? I mean, especially given the pressure on inflation, right? I mean, are we still, if the price of many of these commodities and the cost of transitions into more renewable energy going to be more expensive, are we still committed, do you think? Anyone? All of you? Transitions to the green economy, to green energy.
I think I'll answer from a global perspective, which is the easier answer. I think the commitment of globally is there. We've seen the Paris Accord, we've seen more talk. The G20 has, the ASEAN summit and the G20 has confirmed that climate is at the center of the problem, and then it kind of mandated more role for multilateralism to prevail. However, the implementation remains a little bit slow. We've seen all the shocks that, whether it's El Nino, whether it's the floods, whether it's climate change is real, and the only way to fight it is to reduce emissions. I mean, energy is a big part. Now, you know, there's this big global debate on who does what before. Is it advanced economy? Is it emerging market? The needs for financing. The reality globally is that everyone will be affected. And the country that moves more towards a greener type of growth will have much more benefits in the future, at least in terms of not necessarily mitigation, but resilience, and how do you cope with those.
Perhaps to add, Reza, yes, indeed, this shift to renewable energy is very topical, and yeah, as Pak Mansur has mentioned, there's a commitment to do that. But also, we have to recognize that given this sort of environment, many countries are also trying to push back a little bit because, you know, many economies, they have gone through, you know, a commodity price shock, right? And to have these initiatives implemented during this time where some countries are still facing the high cost of living crisis, and for some governments, the fiscal space is not. We're trying to rebuild the fiscal space, but you know, the fiscal buffers are there to actually prepare for future risk. So they have to, you know, undertake a very difficult balancing how much they want to do now versus what is ideal, because some of these, I mean, these are very long-term and you know, multifaceted, and involves a lot of other challenges, like even like capacity for countries to do that. So I guess there is some concern about whether, you know, the pace of trying to achieve this objective should be accelerated, or should we also try to pace ourselves? Thank you.
Yeah, I'm quite pessimistic on this one, is basically. I mean, look at what we have seen right now. Who is responsible for these inflations? Is it the Federal Reserve, the central bank, or somebody else? I think it seems to me the politicians is responsible for this one. But they tried to ask the central bank to solve this problem, basically. So similarly for these ones, I mean, it's easy to have a commitment. We say it in the G20, in the climate, but the implementations, I think, I'm quite pessimistic in the short term, near 2-3 years down the road. This is remain an empty promise.
Okay, since Pak Raden entered that arena, let me get to the bottom line of these questions. And I think this is something that also has been presented in some of your presentations. We have geopolitical tensions, obviously. We have also fragmentations, to borrow your word, Pak Mansur, of global economic networks. Yeah, we also have heard the term friendshoring being used by officials from the US. Yeah, and alignment and non-alignment has been an issue for us. And I think the implications of that also has increased. Now, study by IMF has shown also that has impacted on all type of capital flows. Geographical distance become less important, geopolitical distance become more. Now, for us, obviously, at the insurance, that's going to increase the uncertainty and the risk, yeah, both globally and also locally. How do you see this in terms of playing out? You know, I mean, again, to me, I can understand when we talk about all these inflations from the economic perspective, but if you're talking about inflation because of supply chains, questions that Pak Raden was asking, who is responsible for this? If it is because of geopolitical tensions, fragmentation of global economic networks, then what are the role and how do we see and how do we price in that kind of risk from the perspective of insurance and also, of course, pension as well? Anyone, please.
Listen, let me start. I'll take the bullet. I don't have a direct answer on how you price it in that. But what we believe is happening is that we are going to a more fragmented world. A fragmented world meaning supply chains are not as efficient, meaning shocks will come at will become more frequent, whether it's price shocks, whether it's quantity shocks, they will become much easier, and then that creates also tensions that could create even wars. I mean, military tension, which will spur another round of militarization, spending more on those issues as opposed to spending on development. The only way I think forward is to make the case, like Indonesia is making, is that it could be beneficial for everyone to cooperate on trade, to cooperate on climate, to cooperate on food security. I mean, there are low-hanging fruits and agendas that could be the start, and I've just named 3. But moving forward, at least in the near term, we're going to see more and more fragmentation, and we're seeing less of the world that we knew in 80s, 90s, and early 2000s when, you know, WTO was thriving and the global economy was thriving?
Yeah, I think the geopolitical risks will remain there for some times in the future. Again, as I mentioned about the Thucydides trap, as we see right now, it will not end over the next 2 to 3 years. Could be 5 years, 10 years. And the political rhetoric from the US and also from China right now is still, I mean, hit it, yeah. And similarly, the climate change. Yeah, the climate change, I think, will be continue to be there. And I don't see, again, as I mentioned before, I don't see any full commitment from all the leaders with this kind of geopolitical risk that we see right now. So the risk certainly increase. But for Indonesia, I think what we can do, again, one, of course, Indonesia already taking a multi-alignment, not always meant someone as non-block. We are non-block, but multi-alignment in a sense that we can work together with many other countries, including with the US, with China, with BRICS, with OECD, right? I think that's the good strategy that Indonesia have to take. And second is basically try to have a local solutions, domestic solutions. We cannot solve the global problem that we face right now. But if we do it more efficient, if we use capital more effectively, if we can implement the policy, the initiative more effectively, I think that's the best that we can do domestically.
Perhaps a couple of observations to the question. Number one, I think we have to recognize that the traditional drivers of trade or capital flows that are based on least cost, efficiency, those are not going to be the standard playbook right now. Right now, I think economic security, the notion of de-risking, all this discussion will enter the boardrooms for you guys are industry leaders. I think it's important that it's recognized that in this environment, a lot of premium is placed, on addressing this risk, where companies try to reduce exposures, try to build resilience in supply chains. And granted, definitely there's going to be higher premium price on the price of risk. But having said that, I must say that there are also opportunities coming out from this sort of fragmentation, this sort of tension. I'm a big advocate of Asian regionalism, and I do find that this RCEP thing is going to be supportive of trying to keep supply chains within the region. So even amidst the rhetorics of all this reshoring, friendshoring, things like that, I think there's a provision in the RCEP that's trying to encourage this, I think that the trending word is the reconfiguration of supply chains, trying to keep that part of the supply chain within the region. And I think we have to be thankful that we have that sort of agreement when many countries are retreating, right, from multilateralism, because this is something that one country alone cannot solve. Right? Thank you.
I hear the music, and usually that's the end of the show. I still have 3 minutes, so let me just, instead of pulling up another questions, and we have to deal with the music, let me just summarize some of the key issues that I think we probably have to go again in the afternoon sessions and tomorrow. I guess the risk is still going to be there. In addition to what we see, a typical market risk, operational risk that we face at our own industry, looks like what we have heard from our colleague this morning, overall productivity risk is going to be an issue. Geopolitical risk is going to be an issue. Climate risks are still uncertain. That could be part of the potential vulnerability that we have to be able to price for our own insurance. And at the end of the day, there has also been debates in terms of how do we move forward in terms of dealing with this current energy and food I would not call it crisis, but a challenge that we face in the countries. With that, let me just thank all the speakers, Pak Mansur, Anthony, and Pak Raden. And I want to thank also all the questions that are coming in, and thank you for staying with us. Again, we will have, how long we have, can I pass this back to the MC to announce the lunch plan and also when we do have to come back to our sessions.
Thank you so much. Thank you, our moderator and our speakers. Thank you so much for your enlightening and a very fruitful discussion in our first session. And please remain on stage. We're going to have another photo session. And I also would like to invite Ibu Sumiati as Commissioner of the Indonesia Financial Group to extend our sincere token of appreciation to our honorable speakers and moderator. Ibu Sumiati will pass the token of appreciation to each gentleman on stage, to our speakers and also moderator. Really hope that the first session can give you a deepened understanding or strengthen the anything related to the topic, of course. And please follow with photo session. Thank you so much, Ibu Sumiati as Commissioner of the Indonesia Financial Group, and all gentlemen, thank you so much once again to our honorable speakers and moderator. Thank you for the amazing first session. You may return to your seat. Thank you so much. Once again, please give a round of applause to all our speakers and our moderator. And after we have heard some points of view from a great discussion, really hope that you guys have a related understanding regarding to the topic that brought up or been discussed before. And I really hope that you guys are hungry, because we are going to fuel ourselves with at the lunch break. It's time for us to fill our energy back. And we are going to have a lunch break at the foyer. Basically, is in the front of this ballroom C, right in front of our main room right now. And don't forget, we are all right, ladies and gentlemen and distinguished guests, so please you to have a lunch break before we continue our IFG International Conference 2023 with the second session with the topic Pension Fund Strengthening Investment and Asset Allocation Strategy. And we will begin at 1:45 p.m. local time. Ladies and gentlemen, kindly be informed that the upcoming session does not have designated seats. So for the second session, please feel free to choose your seating and accommodate other registered participants accordingly. Your understanding and cooperation are greatly appreciated. Once again, I would like to remind you that our second session will start at 1:40 p.m. with the topic Pension Fund Strengthening Investment and Asset Allocation Strategy. And as a gentle reminder, we also provide you with the translation devices, so you can choose both a language, Bahasa Indonesia or English. So hope this our next session will make it easy for everyone. And once again, please take care of looking after our belongings, and let's be mindful not to leave any personal items unattended. Enjoy your lunch, and we'll see you at the second session in Indonesia Financial Group International Conference 2023.
The financial sector plays a fundamental role in the economy of Indonesia, one of which is to be the source of financing to support Indonesia's ambition and aspiration of becoming one of the top 5 largest economies in the world by 2045. By then, the nominal GDP of Indonesia is expected to reach more than $7 trillion, with GDP per capita increasing to 5 to 6 times greater than its current position. To finance such a large project, the role of the financial sector needs to be broad-based and balanced at the same time. However, when examined from the current conditions, Indonesia's financial sector is still relatively underdeveloped. In 2020, Indonesia's total financial sector assets are still around 115% of the nominal GDP, while the average of developed economies' financial sector at least around 300% of the country's nominal GDP. A well-balanced development of the banking and the non-bank financial sectors is a common feature of a developed country's financial sector. The financial asset structure of Indonesia currently is still very much concentrated around the banking sector and the capital market. Meanwhile, the non-bank financial institution sector, especially insurance and pension fund, is still very small in terms of the asset size. Therefore, a rapid and sustainable growth of the insurance and the pension fund sector is going to be a major agenda of the financial sector development of Indonesia in the next 2 decades. Insurance and pension funds are among the largest investors in the financial market, allocating a significant portion of their assets to capital market instruments, typically around 80% of their total assets. Economic downturns can indeed impact their investment returns, which in turn can affect their ability to fulfill policyholder obligations. So the role of investment strategy, risk management, and good corporate governance are among the essential traits in the overall development of a prudent, competitive, and sustainable insurance and pension fund ecosystem in Indonesia. However, the insurance penetration and the financial inclusion rates index of Indonesia are still relatively low in comparison to the ASEAN 5 countries. The low penetration and inclusion rates in Indonesia are also confirmed by the literacy survey conducted by IFG Progress. In general, the survey found that insurance literacy at the university level in Indonesia can be classified as moderate. Furthermore, when viewed based on the dimensions of literacy, most respondents are still moderately literate in the understanding dimension and are classified as quite low in literacy for the knowledge dimension. As a strategic state-owned holding company in the sector of insurance, underwriting, and investment services, Indonesia Financial Group, or IFG, through its think tank IFG Progress, present the second annual IFG International Conference aims to cement further the commitment of the Indonesian Financial Group, or IFG, to provide platform for policymakers, industrial players, and other relevant parties to discuss and debate current and future challenges facing the development of the insurance and pension fund in Indonesia. As for the first IFG International Conference, the discussions in the second annual IFG Flagship International Conference will start with an update of the ever-changing global economic and financial landscapes. On the pension fund, The focus will be on the liability-driven investment strategy. The conference will then touch upon several immediate and structural challenges facing the insurance industry, from the implementation of the IFRS 17 and the vast opportunities awaiting the micro-insurance and Sharia insurance sectors. The conference ends with a special session debating issues surrounding the adoption of the insurance guarantee scheme in Indonesia as stipulated under the newly passed bill on the development and strengthening of the financial sector.
Tick, tick.
When examined from the current conditions, Indonesia's financial sector is still relatively underdeveloped. In 2020, Indonesia's total financial sector assets are still around 115% of the nominal GDP, while the average of developed economies' financial sector at least around 300% of the country's nominal GDP. A well-balanced development of the banking and the non-bank financial sectors is a common feature of a developed country's financial sector. The financial asset structure of Indonesia currently is still very much concentrated around the banking sector and the capital market. Meanwhile, the non-bank financial institution sector, especially insurance and pension fund, is still very small in terms of the asset size. Therefore, a rapid and sustainable growth of the insurance and the pension fund sector is going to be a major agenda of the financial sector development of Indonesia in the next 2 decades. Insurance and pension funds are among the largest investors in the financial market, allocating a significant portion of their assets to capital market instruments, typically around 80% of their total assets. Economic downturns can indeed impact their investment returns, which in turn can affect their ability to fulfill policyholder obligations. So the role of investment strategy, risk management, and good corporate governance are among the essential traits in the overall development of a prudent, competitive, and sustainable insurance and pension fund ecosystem in Indonesia. However, the insurance penetration and the financial inclusion rates index of Indonesia are still relatively low in comparison to the ASEAN 5 countries. The low penetration and inclusion rates in Indonesia are also confirmed by the literacy survey conducted by IFG Progress. In general, the survey found that insurance literacy at the university level in Indonesia can be classified as moderate. Furthermore, when viewed based on the dimensions of literacy, most respondents are still moderately literate in the understanding dimension and are classified as quite low in literacy for the knowledge dimension. As a strategic state-owned holding company in the sector of insurance, underwriting, and investment services, Indonesia Financial Group, or IFG, through its think tank IFG Progress, present the second annual IFG International Conference aims to cement further the commitment of the Indonesian Financial Group, or IFG, to provide platform for policymakers, industrial players, and other relevant parties to discuss and debate current and future challenges facing the development of the insurance and pension fund in Indonesia. As for the first IFG International Conference, the discussions in the second annual IFG Flagship International Conference will start with an update of the ever-changing global economic and financial landscapes. On the pension fund, the focus will be on the liability-driven investment strategy. The conference will then touch upon several immediate and structural challenges facing the insurance industry, from the implementation of the IFRS 17 and the vast opportunities awaiting the micro-insurance and Sharia insurance sectors. The conference ends with a special session debating issues surrounding the adoption of the insurance guarantee scheme in Indonesia as stipulated under the newly passed Bill on the Development and Strengthening of the Financial Sector. The financial sector plays a fundamental role in the economy of Indonesia. one of which is to be the source of financing to support Indonesia's ambition and aspiration of becoming one of the top 5 largest economies in the world by 2045. By then, the nominal GDP of Indonesia is expected to reach more than $7 trillion, with GDP per capita increasing to 5 to 6 times greater than its current position. To finance such a large project, the role of the financial sector needs to be broad-based and balanced at the same time. However, when examined from the current conditions, Indonesia's financial sector is still relatively underdeveloped. In 2020, Indonesia's total financial sector assets are still around 115% of the nominal GDP, while the average of developed economies' financial sector at least around 300% of the country's nominal GDP. A well-balanced development of the banking and the non-bank financial sectors is a common feature of a developed country's financial sector. The financial asset structure of Indonesia currently is still very much concentrated around the banking sector and the capital market. Meanwhile, the non-bank financial institution sector, especially insurance and pension fund, is still very small in terms of the asset size. Therefore, a rapid and sustainable growth of the insurance and the pension fund sector is going to be a major agenda of the financial sector development of Indonesia in the next 2 decades. Insurance and pension funds are among the largest investors in the financial market, allocating a significant portion of their assets to capital market instruments, typically around 80% of their total assets. Economic downturns can indeed impact their investment returns, which in turn can affect their ability to fulfill policyholder obligations. So the role of investment strategy, risk management, and good corporate governance are among the essential traits in the overall development of a prudent, competitive, and sustainable insurance and pension fund ecosystem in Indonesia. However, the insurance penetration and the financial inclusion rates index of Indonesia are still relatively low in comparison to the ASEAN 5 countries. The low penetration and inclusion rates in Indonesia are also confirmed by the literacy survey conducted by IFG Progress. In general, the survey found that insurance literacy at the university level in Indonesia can be classified as moderate. Furthermore, when viewed based on the dimensions of literacy, most respondents are still moderately literate in the understanding dimension and are classified as quite low in literacy for the knowledge dimension. As a strategic state-owned holding company in the sector of insurance, underwriting, and investment services, Indonesia Financial Group, or IFG, through its think tank IFG Progress, present the second annual IFG International Conference aims to cement further the commitment of the Indonesian Financial Group, or IFG, to provide platform for policymakers, industrial players, and other relevant parties to discuss and debate current and future challenges facing the development of the insurance and pension fund in Indonesia. As for the first IFG International Conference, the discussions in the second annual IFG Flagship International Conference will start with an update of the ever-changing global economic and financial landscapes. On the pension fund, the focus will be on the liability-driven investment strategy. The conference will then touch upon several immediate and structural challenges facing the insurance industry, from the implementation of the IFRS 17 and the vast opportunities awaiting the micro-insurance and Sharia insurance sectors. The conference ends with a special session debating issues surrounding the adoption of the insurance guarantee scheme in Indonesia as stipulated under the newly passed Bill on the Development and Strengthening of the Financial Sector. The financial sector plays a fundamental role in the economy of Indonesia, one of which is to be the source of financing to support Indonesia's ambition and aspiration of becoming one of the top 5 largest economies in the world by 2045. By then, the nominal GDP of Indonesia is expected to reach more than $7 trillion, with GDP per capita increasing to 5 to 6 times greater than its current position. To finance such a large project, the role of the financial sector needs to be broad-based and balanced at the same time. However, when examined from the current conditions, Indonesia's financial sector is still relatively underdeveloped. In 2020, Indonesia's total financial sector assets are still around 115% of the nominal GDP, while the average of developed economies' financial sector at least around 300% of the country's nominal GDP. A well-balanced development of the banking and the non-bank financial sectors is a common feature of a developed country's financial sector. The financial asset structure of Indonesia currently is still very much concentrated around the banking sector and the capital market. Meanwhile, the non-bank financial institution sector, especially insurance and pension fund, is still very small in terms of the asset size. Therefore, a rapid and sustainable growth of the insurance and the pension fund sector is going to be a major agenda of the financial sector development of Indonesia in the next 2 decades. Insurance and pension funds are among the largest investors in the financial market, allocating a significant portion of their assets to capital market instruments, typically around 80% of their total assets. Economic downturns can indeed impact their investment returns, which in turn can affect their ability to fulfill policyholder obligations. So the role of investment strategy, risk management, and good corporate governance are among the essential traits in the overall development of a prudent, competitive, and sustainable insurance and pension fund ecosystem in Indonesia. However, the insurance penetration and the financial inclusion rates index of Indonesia are still relatively low in comparison to the ASEAN 5 countries. The low penetration and inclusion rates in Indonesia are also confirmed by the literacy survey conducted by IFG Progress. In general, the survey found that insurance literacy at the university level in Indonesia can be classified as moderate. Furthermore, when viewed based on the dimensions of literacy, most respondents are still moderately literate in the understanding dimension and are classified as quite low in literacy for the knowledge dimension. As a strategic state-owned holding company in the sector of insurance, underwriting, and investment services, Indonesia Financial Group, or IFG, through its think tank IFG Progress, present the second annual IFG International Conference aims to cement further the commitment of the Indonesian Financial Group, or IFG, to provide platform for policymakers, industrial players, and other relevant parties to discuss and debate current and future challenges facing the development of the insurance and pension fund in Indonesia. As for the first IFG International Conference, the discussions in the second annual IFG Flagship International Conference will start with an update of the ever-changing global economic and financial landscapes. On the pension fund, the focus will be on the liability-driven investment strategy. The conference will then touch upon several immediate and structural challenges facing the insurance industry, from the implementation of the IFRS 17 and the vast opportunities awaiting the micro-insurance and Sharia insurance sectors. The conference ends with a special session debating issues surrounding the adoption of the insurance guarantee scheme in Indonesia as stipulated under the newly passed Bill on the Development and Strengthening of the Financial Sector. financial sector plays a fundamental role in the economy of Indonesia, one of which is to be the source of financing to support Indonesia's ambition and aspiration of becoming one of the top 5 largest economies in the world by 2045. By then, the nominal GDP of Indonesia is expected to reach more than $7 trillion, with GDP per capita increasing to 5 to 6 times greater than its current position. To finance such a large project, the role of the financial sector needs to be broad-based and balanced at the same time. However, when examined from the
Ladies and gentlemen, kindly proceed to the main room and please be seated as we will continue our session in a few minutes. Once again, ladies and gentlemen, our next session is about to begin. Please be seated. Thank you. Welcome back, distinguished guests, ladies and gentlemen. Welcome back once again to the IFG International Conference 2023. So before we begin our second session, I would like to ask everyone in this room, how was your lunch, everyone? Is it good? Feeling full and you got the power back? Yes? I cannot hear you. You got the power back? All right, so I believe that everyone is ready for our second session for today. And we still have an interesting topic and speakers in this afternoon session. Hope you guys are not feeling too full, so you can be focused on our second session discussion. As we transition to our next session, I would like to inform you that there will be a question and answer session. You can ask directly to the intended speaker through our moderator later on. And however, we also provide a unique, we also provide a QR code to submit your question, as you can see in our screen. So you can scan this QR code and you can drop your question there. Please kindly scan the QR code, and once you scan the QR code, then you will be able to submit to your question. Or you can ask directly through the Q&A session with our moderator later on. All right, ladies and gentlemen, distinguished guests, let's move on to our second session with the theme Pension Fund, Strengthening Investment and Asset Allocation Strategy. And in this second session, we'll update the current development of the pension fund sector in Indonesia and the challenges facing the development of the industry. It will focus on the structure of the liabilities of the sector and on the practices of the liability-driven investment, or LDI, allocation strategy of the pension fund. Also, we will hear a debate on key concepts behind the LDI and market experiences in the implementation of the LDI. And to conduct this session as a moderator, I'm going to give you some introduction about him. He got Master of Philosophy in Economics from Columbia University, and also Master of Arts in Economics from the University of Chicago. His major fields of interest are macro monetary, international and financial economics, public finance, and development economics. Without further ado, please welcome the Principal Advisor of Macroeconomic Financial Sector and Climate and Energy Policy, Prospera, Bapak Anton Hermanto Gunawan. The floor is yours, sir.
Thank you. Thank you for the nice introduction. That was me in, I don't know, long time ago. That's the picture of me a long time ago. Good afternoon, ladies and gentlemen. We will begin the session, the second session for today, with the topics of shaping the foundation for sustainable that's the total topics, but the topics for this session will be focusing on the investment and asset allocation. But we will have a very good panel, a line of panels this afternoon, starting with the government side, and then from the private sector side, and we also will be learning the experience from other countries, and of course focusing as well on the topics, which is looking at the investment, the so-called the liability-driven investment strategy. So without further ado, I think I just introduce and will ask forward the panels for today. The first one is Pak Adi Budiarso from the Ministry of Finance, Republic of Indonesia. Pak Adi is the head of Financial Sector Policy Center of the Ministry of Finance. Welcome, Pak Adi. Pak Adi has a doctorate in business administration from the University of Canberra, and also Master of Accounting from Marshall Business School in USA, University of Southern California. He's now, as we mentioned before, is head or the director of the Financial Sector Policy Center in the Ministry of Finance, with a list of experience before. There's the second speaker will be from the IFG, group, Pak Pantro Pander Silitonga, who is business director of the IFG. Welcome, Pak. Oh, this is your house. So business director of the IFG, and also the chairman of Bahana TCW Investment Management. Pak Pantro was, we were from the same university, the University of Chicago. Got an MBA from the University of Chicago, and previously also from Indiana University as a bachelor. So then the third speaker will be from Singapore. We are having the opportunity to get Mr. Prakash Kanan, Managing Director and Chief Economist of GIC, the Government Investment Corporation of Singapore. Welcome. Pak Prakash is getting his education in MIT and also Stanford University. Then the last but not least is our fourth speaker from, I think, based in Singapore as well. From Mercer, Singapore, the principal of Mercer in Singapore, Mr. Shash Islam. So educated in, I think, math and economics. Yeah. Math and economics, and also having, some of them are also having CFA charter. So now we have a lineup of very good panelists. The focus of all of this session will be on the investment, I think. It looks like policy, what is the situation right now, ya Pak Adi. You will be talking about the policy and regulation. And then followed up by what is really related, the money, if we can have this money from the pension funds to be used for. One is for infrastructure and the asset allocation, asset liability management and the allocation for the infrastructure. And then also the experience of the GIC on doing the investment from probably some of the proceeds of these pension funds. And lastly, I think is the main topics of this on the one approach, which is important approach on doing investment in the pension funds, which is liability-driven investment. So I think every speaker will have 20 minutes time allocated for the presentation. We can start with Pak Adi Budiarso. I think it's already mentioned by Pak Mirsa and Pak Suhasil previously. He's behind all this omnibus law of the financial sector, law number 4, 2023. Okay, please, the floor is yours, Pak.
Thank you so much, Pak Anton. It's a really kind introduction. Good afternoon, everyone. I think it's a great pleasure for me to be here with all of us. And I do believe not only me, myself, but all of us are behind the transformation regulatory framework, which we call it omnibus law in the financial sector. Let's make applause, big applause for all of us now. Yeah. To be frank, I just would like to send two messages. First, enthusiasm. Because what we are going to do is actually not a reformation. It is a transformation of Indonesian pension system. Yeah. We need strong and very committed and enthusiasm to do that. And the second, probably the one that we currently discuss about investment liability-driven policy and how then make progress in the future. This is kind of the first step, a little step for the huge quantum leap transformation that we want to engage together. Yeah. Let's discuss first on what are the current challenges. Reform in pension system is really essential to ensure the old age pension for workers in Indonesia. Let's name it first. Low coverage of pension system. Yeah. Probably just only 16% of the workers in Indonesia that are currently protected by pension program. Last time, my discussion with the Ministry of Workforce, just only 27% of total 140 million people that are covered by BPJS-TK. What we need to do? For sure, we need to set much higher standard. Majority of the workers in Indonesia should be in the system. It can create confusion, it can create exhaustion, but we need to work very hard. We need to harmonize all pension programs that currently we have. JKK, JKM, THT, JP, name it. We need to focus on how we can put everyone, every worker in the system and start to contribute for the welfare, for their welfare after pension age. The second, pension fund benefits retiree. Now, for most of us, it's only less than 20%, or even less than 10%, before the salary, before pension age. What is the standard? The standard ILO we know already, 40%. It's still far from that, but that's how we need to work very hard to make sure. I think we have the next slide. Slide number 2, I think. Yeah, this one. We need a new design. We need a new design to make sure that everyone can be covered. And the second, the benefits should be enough to prosper, even after 20 years, your retirement age or your pension age. The third one, our great challenge, is on pension benefits withdrawal. Oh, sorry. Yeah. Now we still have a pension benefit that easily accessed before reaching pensionable age. For most of us, it's okay. You have emergency problems, but the global standard, actually, we have to maintain 10% of our salary now for 30, 40 years until your retirement age. That's the money that should go for every single person who work currently for your welfare after pension age. The fourth one is the low retirement and pensionable age. Yeah. Most of the workers even stop working while they are still productive. So that's why transformation must begin. Yeah. A more reasonable retirement age should consider about the increasing life expectancy and also considering the unproductive age for every single person. To be frank, now we have expectancy 74. But look at Australia. When they improve from 6% of GDP, now we're becoming 160% of GDP, their capitalization and pension age, the life expectancy improving by 10 or even more years, 87, something like that. So automatic adjustment for some variables like pension age, minimum and maximum pension benefit should be inputted in our system. Last but not least, this is the foundation. I told everyone already that investment policy is really important. That is part of the key on accumulation of the pension fund in Indonesia. Yeah, Pak Mirza already informed us. This is only less than, pension and insurance just less than 13% of GDP. Look at Malaysia, they're already 65%. Look at Australia, look at advanced countries. So we would like to see the transformation not only based on our problem, but we would like to see based on the opportunity. So the opportunity is huge, but the opportunity must be handled with care, must be handled with better system, must be handled with better enthusiasm to support, to provide the support system, to also make sure people transform their habit from becoming free person, no insurance, no pension, even no tax. But now we must consider, look, this is good for you. This is good for the economy. So the transformation must begin as soon as possible, must begin now. The next slide, I would like to this one. This is portraying how contribution programs in the economy is just only 6.3% of the pension fund. Total with insurance, just only 13%. And you know what? The covered one, that's only 26% of the workers. That's the mandatory one. The asset pension program, unfortunately, right after 2020, is decreasing. So this is an alarm here. Something wrong. Something must be done, together. Let's review on the foundation currently. Next slide. Yeah. When we call it omnibus law, what exactly in the omnibus law? So that's the one that we would like to fill in the gap and to start the new habit, start the transformation, we call it. First, we revoke the law on pension that's already 30 years old. So that means we have been doing this at the constant time for 30 years. So this is time for transformation. In general, it regulates the increasing option standard, especially for institutional bank and life insurance to form pension fund. Now we welcome the trustee. Trustee can be happening in Indonesia, similar like Australia. Now we have increasing flexibility in managing more than one pension scheme. Now we have updating design for fit the current development, especially for regulating pensionable age and pension fund. And we need to also enhance, when we call it pengembangan penguatan or Undang-Undang P2SK, the ingredients consisting two big part, which is one, strengthening authority to govern or to support the accumulation of the funding, and the second is supporting the development of industry. And we also touched the amendment of the law number 40/2004, which is the limitation of the early withdrawal. Yeah. Introducing two accounts that this is the one that we're currently working with the workers. The challenge is actually on the acceptance, the trust building that we need to develop. Yeah. First account is probably the one that can be withdrawn, yeah, for emergency needs, and the second one must be kept until your retirement age. Global standards should be, those of them should be put in the system until retirement age. But in Indonesia, probably we need such kind of a bridging process. So this is the one that how we can do this introduction to the system that can be accepted by most of the people that currently still have a low literacy. Last but not least, the new regulation that currently we have is actually the one that we would like to promote the better regulatory framework that Indonesia pension system currently has the similar regulatory framework with most advanced countries in the world. First of all, strengthening the governance and investment policy for the pension programs, regulating cut loss policy on pension program, especially that those who are related with budget state, creating the actuarial unit within the regulator. Pak Rianto suggested me during that time about it. Now we have the regulatory framework. So let's now work on it. OJK must have actuarial unit. Minister of Finance must have actuarial unit to support the accumulation of funding, to support the welfare of the people in the long run. And last but not least is harmonizing all pension program right after the enactment of this law. This slide, next slide, is also portraying the transformation also must start with small steps. What I call with small steps is actually, if we try to discuss about the investment policy, let's be mindful about 1%, even 1 single percent on the policy can create accumulative funding for 20 years that's huge. This is the example. The strengthening governance investment and also paying much attention on even 1% of the policy making process in the investment of pension fund may create an optimal return and greatest interest for participants. So I strongly recommend that the liability-driven policy-making process in pension fund should be in place as soon as possible. The policy for the investment must be transparent for every single participant of the pension fund. Must be open, even can be compared between one pension fund to another pension fund. And also must be credible in terms of how to calculate the return for the sake or for better welfare for the participants. And it also will enhance the trust from the participant and all Indonesian pension programs and pension institutions. Let's pay a small part of next slide on the P2SK law or the omnibus law to increase the good governance and management. So this is what we call it, the best practices that can be trying to promote in the Indonesian regulatory framework for pension fund. Formulation of the pension fund policy as its execution must be done by different parties. So with the P2SK law, with the omnibus law, we should prohibit manager of DPLK, of the Financial Institution Pension Fund, from holding position as manager at other pension funds. We need to prohibit also the Financial Institution Pension Fund to handing over asset management to third parties. In Article 143, 40, 169, Article 190, strengthening the regulation to implement robust risk management and good governance. And last but not least is to have adequate competency and experience. Now, if we try to review back on the profession, becoming actuarial in Indonesia currently is a bit quite difficult. But this profession is the one that we really deserve in the future, and even now. We need many more, with the better number and quality. The next slide is on the P2SK law or the omnibus law that aims to the optimal investment policy in the pension program management, including in the pension fund. So this is what we call it when, in the simple terms, the liability-driven approach for pension fund is really needed for Indonesia. So that means the investment policy, the capital market expectation, the strategic asset allocation should be quite matched in terms of the risk management, in terms of the time bonding, in terms of the asset class, in terms of the selection, in terms of the security. So that's all must be for the sake of the most benefit of the participants. So investment practice standard, investment horizon, and participant also in terms of the horizon can be or should be met. Next slide. The P2SK law aims also to increase the optimal investment policy, to support the accountability, the transparency, the investment practice standard, as well as the transparency, the sustainability, I mean. Last but not least, in my slide, we have what's so-called the other regulation on P2SK law that actually currently government is still working on the, after the law, we have to form what's so-called the implementing guidelines, and also the PP, POJK, PBI, as well as the LPS support. We already listened to Pak Swahasil that we have currently PPP program. That means we will have LPS for insurance industry. What about pension industry? Not yet ready. So that's our homework. Our next homework is how pension system, pension program, Indonesia in the future should also be leveling up their governance so that we, in the future, we can try to nurture that the trust building to the participant for the society can be also strengthened similarly to other sectors such as banking and also insurance. So with that, I would like to end my presentation, Pak Anton, and I strongly hope that this is not part of the lesson learned that we currently do, but this is the one that we need to tie it up together, connecting the dots and working together for better transformation for Indonesian pension industry. Thank you so much.
Okay, thank you, Pak Adi. There's still time for the presentation, but we can still move on, I think. But basically, this is the foundation that is being laid out to help the still relatively low pension, either penetration or the level. I think you mentioned about the 6.3%, kind of contribution to the whole the GDP for the economy. And also one thing to keep in mind as well, I think that you touched this briefly, is the Indonesia is and will be entering an era of aging population in, I don't know, 20 years, less than 20 years even. So we have to be prepared with that. And also on the other side, trust have to be built And also you mentioned about some reform on the regulation, on the strengthening in order that we can build the trust for the people to join this, and the governance is also being strengthened. Then lastly is also talking about the policies. Investment policy have to be better to reduce the conflict of interest there. So let's now move on to the second speaker, Pak Pantro. I think we know that he will be talking about, the title of the presentation is linking the investment of these pensions to the infrastructure financing. Please, Pak Pantro.
Thank you. Thank you, Pak Anton. Honorable invitees and ladies and gentlemen, good afternoon. Today I would like to speak about macro asset and liability management, and hopefully we'll see how the insurance and pension funds will contribute to infrastructure funding. So in the past year and a half, we at IFG, we have been tasked by the State-owned Enterprise Ministry to help restructure how the defined benefit pension funds around the state-owned enterprise ecosystems have been governed. And with that, what we came out with was, the first one was the investments guidance around the liabilities-driven investment. And then following that, we've set up a comprehensive due diligence, which includes actuarial due diligence, financial due diligence, and also operational due diligence. Now we're at a later stage where each of the state-owned enterprise, they will have to come up with a roadmap for their respective pension funds, especially defined benefits pension funds. Now, one of the key aspects that we found was missing was a robust asset and liability management. This is actually quite a common concept in financial institutions, where the financial institutions will arrange their asset portfolios to ensure that they can meet their liabilities or their obligations. Now today, we wanted to bring this up to the next level, at the macro level, where we talk not only just at an individual institution level, but we're talking about cross industries. And specifically today, we wanted to talk about insurance and pension funds with the very long liabilities. And then you have these infrastructure projects with a very also long asset maturity when it comes to fruitions and will generate positive cash flows. If you go to the next slide, as we know that a typical infrastructure projects has a pattern of cash flows of elongated S-curve. So typically, it will take some uncertain times to free up the land, and then you need another 5 to 7 years to do the constructions. And so you're talking about at least 7 to 12 years of negative cash flows, because even after you're finished with the constructions, once even it's operational, it will take some time for the traffic to ramp up. So we're talking about 12, possibly 15 years of debt servicing. And the way that the construction companies are now funding for this infrastructure is actually through commercial financing to commercial banks with the commercial terms. And we know that the commercial banks are being funded mostly through short-term deposits. Yeah, so they tend to have also short to medium-term tenor in financing. So this has caused a significant stress in the balance sheet of the construction companies. I mean, practically all of the state-owned enterprise construction companies are now in financial distress. They are a combination of negative cash flows. They are unable to meet their obligations. And when we talk about the debt services, Some of them does not even include the principals component. So to just serve the interest, they don't have enough income matching with their obligations. So we thought that there's got to be a better way of addressing this. And then when we look at the other side of the fence, when we look at the insurance and pension funds, so again, in the past year and a half, we've been looking at pension funds, especially defined benefit funds in SOEs. There's around 69 defined benefit pension funds, and total asset under management around 91 trillion rupiah. There's a consistent theme of one is underfunded, the funds is being underfunded, and second is the actuarial rates that is being used to discount the liabilities typically is much higher than the net yield of investments from their investment assets. So what we found was that the actuarial rate ranged from 6%. I mean, I think there's only one or two pension funds with 6%. But majority is actually between 8 to 10% actuarial rate. So what this means is you have a higher rate to discount your liabilities, which means that your liabilities will be undervalued. And at the same time, your investment yield, net of OPEX, and this is quite significant because typically we look at investment yield before OPEX, which was around probably 6 to 8%, but once you take the OPEX component of it, it's only 4 to 6.6%. So there's a significant gap between the discount rate used to discount your liabilities and the investment yield. And when we look at the portfolio of these investments, they are mostly short to medium term and quite volatile. Yeah? Only about 34% of the asset is being invested in stable government bond. The rest would be around stocks that is highly volatile. You have term deposits, which is short term. You also have a significant portion in property that is actually not so liquid. So what we think is, how can we actually match these two? Is there an opportunity for a macro asset and liability investments? Now, granted that the current OJK regulations, there's a POJK 5, 2016, that encourage pension funds to start investing in infrastructure projects. But the way that it is being prescribed now is that through investing in the corporate bonds of the construction companies. We saw earlier that all of those companies are in financial distress. So if you invest in their corporate bonds, then you are actually presented with a credit risk. Then it is not deemed proper anymore to invest in such companies. Now, alternatively, you can go direct to the infrastructure assets. But the challenge there is that most of the insurance companies are actually too small to even get a bite of the infrastructure assets. Yeah, it's too small. And what we found was, speaking with many of the management of the pension funds, they tend to still have a short-term and at best medium-term investment horizons. While their liability is long-term, but the management's mindset is still short-term or at best medium-term. So again, we thought there's got to be a better way of doing this, and we tried to do a couple of different things, but we thought that we think there's a role for the government to help us do a better asset and liability management for these industries. So what we're proposing is that, so now we know that there is a long liability. So insurance generate premiums, right? And premiums are invested to anticipate future liabilities. Similarly, you have the pension funds, you collect the monthly collections, again, to pay for the future liabilities. And then on the other side, then you have the infrastructure, with a elongated S-curve cash flow that we discussed earlier. Now, what we're proposing is to have a special purpose government bond. So we think that the better asset and liability management can be facilitated by the government through a special purpose government bond intended to support the infrastructure projects. So this government bond must have a minimum of 10 years, but preferably then you have a longer than 10 years tenor, right? And that can be allocated specifically for the infrastructure projects. Now, if we look at, go to the next slide, our demographics. I mean, Indonesia has the most young and active and productive populations. We have 135 million active population. That means it is now time for them to produce, to generate incomes, right? But again, we have to anticipate that down the road, right, then we have to pay for the pension liabilities. And on the other hand, when we look at the infrastructure projects, and we're building now, I mean, we're still a growing economy. We need to build these infrastructure projects, right? And the good thing is, and we've looked at some of those projects, actually, the rate of return is not too bad. We're looking at, right now, a Trans-Java toll road with a length of 39 kilometers, with an IRR of around 15%, 15% IRR. But again, our challenge was that elongated S-curve cash flows. So there's a potential here with these two industries. And we know that other countries, like neighboring countries like Singapore, Thailand, I mean, which we heard earlier that they have a higher penetration in insurance and both also in pensions. They have provided incentives for long-term deposits. For example, in Thailand, if you buy endowment, an insurance product endowment with a minimum of 10 years, and the premium can be tax deductible. So it's not just a tax relief, but it actually can lower your taxable income. And then we'll look at Singapore specifically, where we think to a certain extent the concept has been applied. And if you think about it, Singapore has a much lower GDP than us, right? Pak Reza, I mean, we have the biggest GDP in Southeast Asia. Yet, when you look at the pool of funds, the total pension funds in Indonesia is around 1,000 trillions. In Singapore, it's 6,000 trillions, 6 times of our pension funds pool. How can it be? I mean, a tiny nation with a much smaller GDP, yet has 6 times the size of our pension funds pool, right? So the way they do it there, the way it works is that, so the MAS, Monetary Authority of Singapore, issued a special government bond. It's called the SSGS, or Special Singapore Government Securities, which will then be subscribed by the Central Provident Fund. Central Provident Fund is the consolidated pension funds. Unlike here, we have many pension funds with different purposes. There they only have one. And these pension funds, not only for retirement, but also for home ownership as well as for health savings. Now, the proceed that they collect from the pension fund is then reinvested through their sovereign wealth fund, or GIC, which can then be used to fund for strategic projects. So not exactly the same, but I think the concept is government provide a certain incentive for the residents and the working residents to put in money. And the thing is, they give a better yield. So for example, a normal government bond yield of around 0.5 to 4%. SSGS can give you a yield up to 6%. Up to 6%. Yeah, but again, this money can be used to fund for government strategic projects. And it is quite huge. I think as of now, it stands at close to $400 billion. $400 billion. So again, 6 times the size of our total pension fund pool. Okay, lastly, so with that, so we have a couple of recommendations. This is quite provocative. I will take the blame for this recommendation. So I think I'll go with the second one first before the first one. And again, my apology for being so blunt on this, but we don't think that infrastructure project, and especially for greenfield and large scale, should be funded through the construction company's own balance sheet. I mean, we are in a situation where we are in right now. We're seeing that the construction company's balance sheets, they're all in distress because of this. We think that it's, you know, the role and responsibility of the government to take on funding for such large-scale projects. Now, the second one, which is the first one in the screen, is actually to facilitate a better asset and liabilities management between these industries. We really think there is an opportunity to really boost the insurance penetrations, boost the pension fund penetrations through government interventions by using a special purpose government bond specifically designated for infrastructure projects. So with that, I end my conversation. Thank you very much.
Okay, thank you, Pak Pantro. It is interesting to hear about this strategy and how we can look at from the macro side, how to generate this through the government special purpose government bonds in order to link and to reduce the risk for the pension funds and also to help the infrastructure financing. Okay, let's now move on to the third speaker, which is, I think is linked, a little bit linked to what Pak Pantro said, which is the experience of the Singapore. Pak Prakas, please, the floor is yours.
Thank you, and selamat siang, I guess, to everyone. I think this is maybe some conspiracy from IFG, because I'll be talking very similar things that Pak Pantro just talked about. But this is really about the Singapore experience, both in terms of our defined contribution system, as well as how that links with GIC. So in Singapore, the defined contribution system is called the CPF, the Central Provident Fund. So it's a savings scheme. So the worker gives 17%. Worker gives 20% of their monthly salary up to a cap, and the employer gives another 17% of the monthly salary. And that is distributed into the first 3 accounts while you're working. So the first one is called an ordinary account. You can think of the ordinary account as a checking account. So you can actually, even while you're still working, you can actually withdraw money from the ordinary account and use it for certain things. So you can use it for education, you can use it for buying a house, so these kind of big ticket investments. But the rule is that you have to pay it back. And then the special account, you can think of that as a fixed deposit. So the special account is something which you can only take out once you hit the retirement age. And then MediSave accounts, which is the third one, is an account that you can use to fund some of your kind of extraordinary medical expenses. And then retirement account is something that once you hit age of, now it's 62 and above, they will convert some of your funds into the retirement account. But the important thing here is that as a worker, you are giving money to the fund, but you're getting a guaranteed rate of return, right? So your returns do not fluctuate with the market, but it's actually a fixed rate of return. So your ordinary account gets roughly about 2.5%. Your special account can get up 4%, but in some cases, actually even up to 6%. So the interesting thing here is that we introduced a floor to the rate of interest that, that the CPF accounts give. So during the times when the domestic interest rate actually fell below the floor, you were getting a much higher rate of return on your CPF accounts than you would in your bank deposits or even in government bonds, as Pantro was talking about. So how does that go to GIC? And I think here, in a similar chart, I think that was shown earlier. So the members give the money to the CPF board, and so that's the liability of the CPF board. And then the CPF actually subscribe to this thing called Special Singapore Government Securities. Now these are the liabilities of the government, and then those funds, as the withdrawals come about from retirees, the flows go from the government back to CPF. So where does GIC come in? So you have the money going from the CPF into the Special Singapore Government Securities. Now that gets mixed up with other sources of funds. So the Singapore government also has kind of periodical land sales, as well as any surpluses that the government has. All of that goes into the MAS, the Monetary Authority of Singapore, which is then converted to foreign reserves. And that's what's passed on to GIC to manage. Now, what's the benefit of this system? Now, the benefit of the system is that, from GIC's perspective, not kind of fully taking into account the CPF liabilities really allow us to think about long-term investing. And what stands in between GIC and the pension funds is really the balance sheet of the government. So at times when investment returns are poor, we do have a stock of reserves that can help kind of fund the drawdowns. But at the same time, when investment returns are high, actually then we build up a bit of a war chest for future investments. But I think it's very important here that the government, in a way, stands between GIC and the CPF, because that really enables us to take a lot more long-term investment risk. And if you look at our asset allocation, so I don't know if the font is maybe a bit too small. So the first one, which is the 24 to 28% slice of the pie chart, that's still held in bonds and cash, right? So it is a little bit larger than most long-term investors, but the primary reason for this is really to serve as a diversifier, as well as a kind of a stress loss protection. So in times when the markets are down, we still think that fixed income, even though in some scenarios as we experienced last year, you have kind of positive correlations, we think in general bonds still provide a good source of diversification for the total portfolio. The second one, which is within the 20 to 30%, is really developed market equities. And then the third one, which is 15 to 20%, is emerging market equities. Now, usually for a lot of funds, 15 to 20% is a lot of capital that we put aside for emerging market equities. But once again here, with the ability to take a longer term horizon and more risk, we are actually able to do more in emerging markets than would otherwise be the case. And then the last two slices of the pie here are in private equity and real estate. Now, within the real estate slice, I think as what Pantro was talking about just now, is also houses a lot of our infrastructure allocation. Right? So the real estate here is really kind of real estate and infrastructure. So if you sum up the private equity and the real estate, we have about 25% of our portfolio in private markets, which are also in general quite illiquid. So a lot of the private equity funds have lockup periods of between 5 to 7 years. Our infrastructure projects, usually about 10 plus years. Real estate between 5 to 10 years. And once again, that ability to take kind of long-term risk, particularly illiquid risk, it helps a lot that in a way we are insulated from the liability profile of the CPF. Now, this pie chart here is not everything that GIC invests in. We actually subsequently use this portfolio to fund more kind of diverse and active strategies. But all the while, basically the governance is that the board, which is actually chaired by the Prime Minister of Singapore, approves the asset allocation, which kind of helps us with the risk tolerance. So for example, if you want to invest in a credit asset, which is not included here, we will finance the credit investment by some mixture of equities and bonds so that we preserve the overall risk tolerance of the client. And really, I think one of the true benefits of being in this kind of framework is, as I mentioned, really having that ability to take on the long-term orientation. But it does have one more benefit, which is that if you think about it, so you have the CPF and the government which is giving a fixed rate of return, but then GIC is actually making potentially excess returns on top of the fixed rate. So what we introduced about 15 years ago is a mechanism that actually gives some of the excess returns from GIC back to the government to spend. So that's the formula that we have up there. We call it the net investment returns contribution. So what it means is that if GIC actually makes more money than the liabilities that the government owns to the CPF, we can actually give up to 50% of the returns back to the public finances. So it's not just kind of helping the government think in terms of long-term and in terms of, call it a rainy day fund, but it also functions very much as an endowment fund in the sense that we are actually helping to finance Singapore's government budget on an annual basis. So if you look at that little box on the side, so you have the usual government's operating revenue and operating expenditure, which gives you the primary surplus. Part of that is actually funded by the contributions from GIC. And it is not a trivial amount. Actually, the contributions from all the reserve management entities into the government budget is the single largest revenue item for the Singapore government. It gets more from its reserves than it gets from corporate taxation. So it's about 20% of government revenues, is about 3.5% of GDP. So this is I think an additional benefit just because of the way that the structure is, that you're giving a fixed rate of return to your pension fund owners, but you are getting a variable rate of return, which, because you're taking more risk, over time tends to give you higher returns. So that's the setup in Singapore. And as I mentioned, I think it does lend some benefit with regards to insulating an entity like GIC from, being too driven by the structure of the liabilities, being able to take long-term risk, being able to take illiquidity risk, and then part of it actually is that it also allows us to convert ourselves into an endowment model such that any excess of savings or excess of returns that we get can actually be passed back to the government. Let me stop there. Happy to take more questions later during the discussion.
Okay, thank you, Prakash. That's, I think, kind of an expansion of the Papantro's suggestions on the project there. So it has been done for some time in the government of Singapore investment companies. So GIC is one of the probably having a key role there. I don't know whether later on you can discuss this, Pak Pantro, as well, on the role of INA, for example, as whether this is kind of similar part of the like GIC. But then we can move to the last but not least presenter with the topics of trying to link on the liability side of the pension funds to the investment policy and strategy. Please, Sash.
Thank you. Thank you, Anton. And thank you on behalf of Mercer to IFG for inviting me as well. So it's a pleasure to be here. Good afternoon. And I'm going to spend around about 20 minutes or so speaking about LDI. And it's just basically from a UK perspective and my experience from working on LDI for various different pension schemes over the last 15 years or so. So in terms of LDI, there's quite a few different areas where there's a lot of misconceptions in terms of what it means, in terms of how you go about implementing it. So what I'm going to try and cover is what is LDI in terms of its just basic form. Secondly, what's the problem statement that we're trying to solve here using LDI? Third, around just the pure building blocks around LDI. So how do you go about building an LDI solution? And lastly, the growth of LDI over the last 20 years or so in the UK, how it's evolved over time. And then finally, I'll leave with a summary and some top 5 myths of LDI that I believe are quite relevant to pension schemes when thinking about implementing LDI. Yep. So what is LDI? So I guess if I went around the room today and asked 5 different people what is LDI, I'd probably get 5 different definitions of LDI. So you get from different angles and different kind of lenses when you think of LDI. So from my end, what I think of LDI is when you think of from a corporate person, so who sits on the kind of looking after the income statement or the balance sheet, they think of more around how do I actually manage my balance sheet, the liabilities that sits on my balance sheet more appropriately when it's no less volatile. From a trustee perspective, who has a duty to the members or fiduciary duty to the members, they're more concerned about how do I secure the member benefits using LDI. And then you have advisors or regulators where they think about it's probably more an application of ALM, LDI is a tool of that. And then lastly, maybe a cynical one is LDI could be a marketing gimmick used by asset managers to package and sell to pension schemes as well. So I guess those 4 explanations are all right in their respect and their kind of, in terms of how you explain it. But how I kind of think about LDI is more from a risk management point of view. It's a risk management tool to make sure you don't take undue risk, and any risk that you take is actually being rewarded. So first of all, when you look at the 3 different bubbles here, I've put down one of the biggest kind of goal of LDI is to match the scheme's assets and liabilities to make sure they're working in tandem where they actually can. So in terms of where they kind of have similarities is in the risk in terms of interest rate and inflation. So making sure you match them as closely as possible. The last one is around, it's just another tool as part of your toolkit of managing the whole pension scheme as well. And the ultimate objective still stays the same, to making sure you pay the member benefits on time and in full as well. So what's the problem statement? And I guess if you look at the chart in white, you can see the light colored line where the funding level moves about quite volatile in terms of up and downs. So what LDI is trying to do, in a nutshell, is trying to smooth that pattern, a little bit more kind of stabilize that. It gives a bit more certainty in terms of planning. It gives a bit more certainty for the corporates, in terms of certainty for the trustees as well. And within that, the two biggest risk factors for pension schemes are interest rate and inflation. Because interest rate and inflation are inherent in the liabilities in terms of the actuarial assumptions that are used. Also within the assets, where you have asset allocation to, let's say, bonds, you're going to have some form of interest rate exposure there, and also inflation as well. So just trying to match those and working together in terms of as close as possible. There is no perfect match. It's trying to match those that you don't actually get into a situation where one moves more volatile than the other, and you kind of left with a big deficit. Another point around this as well is that it's the reducing the funding level volatility allows the scheme to take more risk on the return-seeking assets as well. So you can actually make the assets work a little bit harder and more efficiently. So as long as you know that the interest rate and inflation risks are not going to discount you in terms of your kind of funding level, you can actually do a lot more on the asset side or return-seeking asset side. So the building blocks around LDI, I put it into kind of a circle form around starting from the top left, where you kind of define the end goal and the glide path. And I think this part is quite important in terms of understanding where you are today, where you want to get to, and also the glide path in getting there as well. So the glide path being like making sure you have milestones of getting there. So the ultimate objective for most schemes is going to be typically to be fully funded, to make sure your assets meet liabilities, and also if you want to get to a position where you can actually offload your pension liabilities to an insurer as well. So that's in the UK, that's called a buyout. So typically that's the kind of, if you want to get to that stage, you probably have to earn more than your liabilities because you have to pay a premium. But again, it's understanding those goals and making those goals line up according to all kind of different stakeholders, and making that glide path as smooth as possible and as making sure there's milestones as you go through. Then the second kind of pillar, I would say, is more around hedging efficiency. So this is looking at your liabilities and making sure, because there's no assets that you can invest that's going to exactly match your liabilities. So what you need to do is take your liabilities and then transform it in a way that's actually investable. So what I mean by that is looking at your inflation linkages in your liability and try and coming up with an idea where it's a bit more fixed and where you can actually use that and benchmark that against your asset strategy against that. The next point is designing your hedging program. And typically, sometimes pension schemes go straight to this point around how do I do my hedging in terms of getting the right assets to match your liabilities without thinking about the first two steps. So that's probably more, having the first two steps actually gives you a little bit more guidance in terms of understanding how you build that program. Now the program can be various different things around what's your right hedge ratio today. Is it based on the funding level? Is it based on the asset level? Is it based on the liability level? So there's 3 different kind of hedge ratios that you need to determine, and how does that evolve over time as well? Then there's a second question, how do you take that hedging position? Through physicals or through derivatives? And does the derivative give you capital efficiency in terms of unlocking more return-seeking assets? Or is that kind of going to be helping you close the kind of deficit gap as well? And then there's a question around, is it more cash flow matching on the shorter end or duration matching at the longer end as well? So these are all kind of things that you need to think about when you're thinking about the hedging program. And lastly, there's an element where dynamic management comes into it. So this is really thinking about how do I take opportunistic bets and also take risk off the table when it's right. It's not done for that purpose, but you need to have some flexibility to be a bit more dynamic. And the last one is probably more closing the feedback loop and making sure you have that kind of robust risk management and governance in place. Because at the end of the day, you're managing your assets against a liability which is inherent with assumptions that's backing it. So those assumptions are still assumptions that you need to update when you get the experience data. So what happens here is you're kind of exposed to basis risk. So you need to make sure that's updated quite frequently. You need to make sure you rebalance quite frequently as well. So as market moves, interest rate bonds, your equity assets, we're going to move your hedge ratio as well. So making sure the hedge ratio is rebalanced back to your target allocation or so. And the lastly is thinking about what you can delegate and what you can't delegate. So delegate means if you don't have the capacity to take those decisions in-house, maybe delegate that to someone who can do it quite quickly without losing that market opportunity as well. So again, that risk management and governance piece just closes that feedback, but the whole circle is an ongoing circle that needs to be continuously monitored. So this is a quick, sort of the last 20 years or so, LDI has grown significantly in the UK. And it started in the 1990s where pension deficits had to be reported under the kind of, on the balance sheet rather than an off-balance sheet item. So under the IFRS 17 and IAS 19 standards, that was the kind of genesis of the idea around LDI. So corporates or CFOs didn't want that kind of exposure on the balance sheet impending their operating kind of normal operating day-to-day kind of way they actually operate the business. So what happened was you see investment bankers came over and said, okay, we can actually create a strategy that allows you to mimic those liabilities to reduce that kind of funding level volatility. So it gives you that stabilization on your kind of balance sheet and reduces your funding costs ongoing as well. And then over time, the pension regulator in the UK, well, big advocate of this, and also kind of new products came through in terms of how you can develop it into pension schemes, how you can actually design it effectively as well. So over the next 15 years or so, that became a bit more of a norm in terms of implementing LDI into pension scheme, DB pension schemes. And I guess the first acid test for LDI was the kind of GFC when there was a question mark, will LDI hold up? So you're taking, in UK, there's a lot of exposure taken by swaps, which are derivative instruments via different counterparties. So in terms of that acid test, it kind of held up really well. Even the swaps that were kind of put in play with Lehman Brothers were unscathed, as in they still kind of went past the kind of all the novation and the kind of checks that they had in place. And the last 2 points were around, then it just kind of exploded over 2014 and 2018 when LDA became really mainstream and leverage was introduced. Leverage allowed schemes to mitigate those kind of interest rate inflation risk, but at the same time work those return-seeking assets a lot more. Then they kind of created pooled assets where smaller schemes could actually invest without being impeded by their kind of size. So these two kind of vehicles allowed that growth, and it went up to around £1 trillion of assets invested into LDI. Today, it's around about 1.5, so 85% of that 1.8 invested into LDI. And again, last year, there was another acid test, I would say, around the liquidity crunch where the budget deficit was announced. So the new budget from the Prime Minister, the short-term lived Prime Minister, who tried to announce that kind of increased spending, gilts moved up, there was a liquidity crunch, but it was all operational rather than a pure LDI structural problem. And it came relatively well because in terms of the outcome, schemes were able to fund those collateral calls, but now the schemes, most of the schemes, the majority of those schemes are sitting on a surplus, which means that gives them a lot more flexibility to give members more benefits, increase their benefits, and corporates to actually take a call on those kind of surplus as well. And just to summarize kind of like the 5 top myths of mine in terms of what LDI means. So the first one is LDI is not a tool to time the market for interest rate and inflation. I've seen schemes or trustees saying, why don't we just use LDI to under-hedge or over-hedge depending on where the market cycle is, if yields are going down or up. But it's not about that. It's about the risk management tool in terms of your whole journey plan. So where I mentioned about the building blocks, about your glide path and end goal, that's the kind of key goal here. Now, not saying that there shouldn't be some form of flexibility, but that's at the margin. The core of it is actually a risk management tool. The second point is LDI is not a risk-free solution. There's still risk inherent in terms of your asset allocation strategy, even your liabilities as well. There's mortality risk, there's demographic risk like early leavers, early retirement, that all needs to be taken into account and how that's managed as well. So the LDI, the solution itself also needs to manage, as I mentioned in the building blocks, around risk governance and making sure that basis risk is minimized through rebalancing as well. Number 3 is the complexity part. Sometimes schemes that I've worked with add extra complexity thinking that it's going to add value, be it synthetic equity, synthetic corporate bonds. So these are the things that sounds great, but at the same time, those complexity doesn't help you get to your end goal. I've worked on schemes that are smaller, and they've actually said they had a small risk budget, and what they said to me is, okay, we can't really afford these really complex strategies, but at the same time, we can't really afford a really detailed strategy. So they delegated that kind of most of those key decisions out. And what we helped them with is more of a broad solution, and it went there with a de-risking plan. So again, that complexity wasn't there, but still they met their own end goal of reaching that buyout level and offloading that pension scheme. So the charity is in a really more stable position they were maybe 6 or 7 years ago. So number 4 is more on the, it's not going to compensate for you for poor performing return-seeking assets. Your return-seeking assets still need to do a job in terms of your equity, in terms of your private assets, whatever you have there, that still needs to deliver in terms of your deficit gap. So the LDI is not going to compensate for that. It's just going to make you more focused in terms of splitting that unrewarded and rewarded risk. And last one, I think I've said it a few times now, it's not a static and set and forget solution. You need to be continually monitoring this and making sure there's recalibrated as the liabilities change, rebalance as market changes, and also making sure you have some form of flexibility to take opportunistic bets as well. So it's an LDI is a kind of ongoing solution that always needs to be kind of thought about in terms of how you manage it over time as well. And your LDI, when you start the program, let's say, right initial stage, it might be just a basic building blocks, but over time, you might see it evolve into a really kind of sophisticated strategy as your strategy moves as well. So it does evolve, but you just need to make sure you evolve as the LDI solution or the market is evolving as well. So that was all I was going to say, just on the topic of LDI, and I'm happy to take questions as we sit down. Thank you.
Okay, thank you, Mr. Sayas. So another approach on how to deal with this managing the liabilities into and turning it into an asset is from the micro perspective here. The other two speakers talking about more macro strategy for the whole use of these pensions, I think, but basically it's just intermediating between the spenders and borrowers. So financial intermediation is one of the key things, which is want to be addressed by the law, the omnibus law, ya Pak Adi ya. So I think we should jump to the Q&A. I think Q&A from the floor first. If there's some questions, please. Anybody from the floors? Okay, let me just try to give some kind of Pak Adi first. I think you heard about these two approaches here. So whether this can be accommodated, and if not yet, how to revise, and about the proposal of how to possibly revise the regulation or the implementing regulation which is being built right now in order to accommodate whether, I mean, these two approaches, if it is deemed to be needed and good for the development of these pensions.
Thank you, Banton. To be frank, I really like this theory. Yeah. First of all, because Indonesia current deepening is still shallow. Yeah. That's why we need more initiative like this. Yeah. LDI actually, that's very good for the sake of the participant, the pension fund participant, because that will be creating first innovative way of matching, yeah, innovative way of trying to improve the benefit for the program, and last but not least is risk mitigation. And yeah, I'm totally agree. This is not free from risk, but we have to manage it. But the second one that I would like to also emphasize is the government currently would like to also see that the program that currently handled by several institutions is not quite transparent yet, Pak. Yeah. For example, the term is as simple as realized loss and unrealized loss. What should we report it? Is it possible for you or you holder of the pension fund know what is exactly your current status of your investment policy? So that's also the one that we currently would like to seek. And last but not least, Mr. Islam already indicated that currently UK industry, 85% are using these tools to at least mitigating all of those risks, eventually after the 2008 financial crisis. I think this is really good, Pak. Thank you.
Yeah, so the disclosure of those information to the pension funds holder is very important, I think, in order to increase the trust, yeah, of this. And
exactly. Yeah, the trust is really, this is the business that we would like to rely heavily, yeah. And then once you put your future into the system, so not only the regulatory framework that currently would like to achieve, we're strengthening also OJK, we're strengthening also the mandating all of the proficiency of the workers or the managers that currently in the system. But not to mention, we also trying now to promote the innovative investment choice, investment policy making process in the pension fund. I think that's really great. Yeah.
Okay, thank you, Pak Adi. We also got some questions through the what is the system there. One is from Mas Aldo, yeah. He said that the current system is the Ministry of Finance sort of cover and chip in the SOE Karya balance sheet. Regarding your second recommendation, this is probably directed to Pak Pandro, yeah. Your second recommendation, what's the difference exactly? Isn't it just move the stress from SOE Karya to APBN? Please,
okay. That's so actually it's not moving the stress from Karya to APBN, because as we explained earlier, these are funds that were generated from either pension funds, collections, or life insurance premiums. Mm-hmm. So the source of the fund is actually not from APBN, right? It's actually additional source of funds, right? In fact, I mean, this is so fortunate that we've heard directly from Prakash, Chief Economist of GIC, which actually have been using this fund with this quite a similar model, right? And from what we heard earlier, they have been contributing actually to the government budget. So it's actually the other way around. It's not taking out of the government budget, it's actually contributing because there's excess or surpluses that can in turn be contributing to the government budget. So again,
but Papandro, probably one of the component in the scheme there is the government guarantee on this kind of return on the government bonds there.
Right.
So then.
Right. So it seems like why is it possible? And in fact, we need to have that government guarantee, as we heard from Prakash. But then we just checked out so while the liabilities stand for around 2.5% to 6%, as we saw earlier, the IRR of GIC investments is around 8%. So even that, there's still a margin. Yeah. But what we're trying to say here is, I think just to answer the question is, it is not actually just moving the stress, because in the current scheme, the funding for long-term infrastructure is from the balance sheet. It's not from APBN, right? It's from the balance sheet of the state-owned enterprise construction companies, right? But then, because they are in financial distress, then the government will have to inject capital. But why do we have to let this cycle go through that way first? Well, if we can actually collect additional funds and then invest in the infrastructure funding. So I think we have to break this vicious cycle of letting the state-owned enterprise construction companies going through the financial distress first, and then the government will have to inject capital.
Okay, thank you, Papandro. There are two questions from this system here, unless there's a question from the floor. You can raise it in Bahasa as well. Oh, over there, on the way back there, please. State your name and your affiliation.
Thank you. My name is Anti. I'm coming from the Belka Associations. So basically, the questions is for the behalf of the government, as we are the pelaku ya Pak ya, from the industry who's doing the selling the pension fund. So what mentioned by Papandro and all of the speakers there are really good, basically, if implemented in Indonesia. The questions from the industry is, what will government's plan, strategy, and to increase the pension fund in Indonesia instead only regulate. We know that P2SK has been to strengthening the financial pension fund, but we know pension fund, specifically DPLK, is really difficult to grow or to develop more because there's so many restrictions for investments that we know managing the risk. So my question's back in how the government will be able to really improving and to help us selling the DPLK, the pension fund, with the guaranteed, the government allocated fund investment, like Pak Pantro mentioned about the pool fund. Let's say 50% of the allocated investment of DPLK should go to the government fund, which is a special guaranteed government, as Singapore already done, which we also know the government has been guaranteed so we can manage the risk. And following the new P2SK regulations, we're not allowed to do the third-party investments. So we just manage the portions that we can manage. Because you know the PLK investment has a limit capability in terms of investment. We may have a very lack knowledge. We know DPLK is very, we don't have the expertise to increase. Meanwhile, every time we do the business plan, the ROI is very low than the target. Why don't you, the government, implemented a certain fund and doing that the Mercer House offering, and we just follow? Because lack of trust will become the base of selling the pension fund in Indonesia. Why they don't want to put the pension? Because they just want to, our money is used directly. But we cannot do the guarantee about this investment knowledge to the community. I think that will be a question back on how we as a DPLK association, we may support that the government, even we have a certain fund allocated. Thank you, Pak.
Okay, thank you. Looks like Pak Adi has the questions.
Yeah, I think thank you very much for the question, and most of are the suggestion rather. Yeah. But for sure, yes, we need to first look at what we currently have. I think this is not the homework for the government side. This is also the homework for all of us. First, let's say the regulatory framework. Yes, we already trying to revise the 30 years old laws. And what next? Even if you try to look back on what are currently doing on our policy, investment policy in DPLK, for example. This was the one that we currently would like to suggest for the improvement in terms of transparency, in terms of modeling, in terms of how then the government can contribute as well. I think that's the one that we need to nurture together. Yeah. I'm not saying, no, we cannot do that, but look at the opportunity. The opportunity is really huge. And the greatest challenge for us is actually on how to improve the deepening, or how to deepen our financial system, particularly driven from insurance and pension. To be frank, now with the current level of literacy and inclusion, we started to think probably let's first trying to make every single person aware that you must save even 3%, 5%, or more than 3% of your take-home pay every single month to the pension system. So that never happened before. That means the awareness and how to collect more, I think that's the one that we really currently would like to work together. Yeah. The second is on the support system. Yeah. Mercer, the way that we're trying to see in the advanced country, is portraying clearly that actually the one you collect fund for the longevity for your 40 or even 30 years after you invest in the beginning, I think that's the one that we need to make sure that the matching program for investing those funds really matters. And how to do that? We need to do it together. This is the one that we started to build up together. Yeah. I'm not saying that it is impossible, but I think there is still big room for opportunity. And the benchmark is there. That's why support system, regulatory framework, and now we're currently talking about the investment policy. Because when we see, for example, how much is currently portion of the DPLK put the funds into a strategic kind of instruments. Most of them still in the what's so called deposito, ya nggak Bu? Yeah, most are still in the deposito. How much is in the other than deposito? A big question. Yeah, now we suggest, okay, probably government can also introduce such kind of instrument. Pak Pantro already indicated, look, this is possible, but for sure it's not free from risk. But at least we are moving towards that area, towards that advancement. Yeah, because we are in the traditional mode of the investing policy for DPLK or DPPK, and then another challenge, for example, for cut loss. This is another problem for not only DPLK, but it's also for the mandatory programs such as PCS and also Taspen Asabri. We are trying to move forward. Look, this is possible. This is the way that we would like to look forward for better transformation, not only reformation. Yeah, this is quite big chunk, but for sure, that's not free from risk. Let's work together. It is possible, but I think that's my.
Okay. Maybe I can make.
Prakash.
Yeah, no, maybe I make a couple of points. So first one, as you know, in the case of Singapore, one way that we have achieved a lot of penetration in the pension space is just by making it compulsory. So all permanent residents and citizens of Singapore have to participate in this scheme. I think the one point that was made by the speaker just now, which is a very important one, is about expertise. And I think it is very difficult, I think, to build expertise, especially in a variety of different institutions. Yes. So even if you look in the case of Canada, so what they've done in Canada is actually in certain states, so in the state of Alberta, so it's an oil producing state in the western part of Canada, they have 17 different pension funds that have grouped together into, and basically they just collect all their funds in one entity called the Alberta Investment Management Corporation. And that entity does the investing for the different entities, and I think that helps. And whether that model is a GSE kind of model or whether the model is LDI, I think is a separate question. But I think that kind of pooled expertise is very helpful. And then maybe related to the first question on the risks, I think as was mentioned earlier, I mean, risk is still very important. So if a bad project is a bad project, regardless of who invests in it or what have you. But where I think the GIC or the Singapore model is so let's say you have your fixed deposit rates that you can get from depositing your money in a bank, and then you have something a little bit higher, which is where the CPF rate comes in, and then you have kind of an expected rate of return from taking on more risk, and that could be more illiquidity risk or more longer-term horizon risk. Now the problem is this higher rate of return is not guaranteed, and so where I think the government comes in is really to protect the pension kind of contributor from the fluctuations that you get in that volatile rate of return. Now, the standard criticism of this model is that if you are a young person, actually you want to take more risk. You don't want a fixed rate of return. So why do I get a fixed rate of return and then the government gets the excess? So what we did in the CPF system is that we allowed the pension fund contributor to actually also allocate by themselves into some risky securities, and then they bear the risk in that. The performance of that in general has been quite poor, and so actually most people just stick to the main product.
Okay, thank you, Pak Prakash. Then, is there any other from the floor? Or okay, silakan, Pak.
I have a question for Pak Adi. Well, if we look at the regulation, on insurance, in Indonesia, valuation of liabilities, is based on very much market consistent philosophy. So valuation of long-term contracts is required to be done using risk-free rate as the discount rate. So this risk-free rate is kind of acting as a benchmark rate, like what Mr. Islam mentioned before. But it's not the case, on the pension side, and on the defined benefits pension side, in Indonesia. Every founder, was given, freedom, to decide, on what discount rate, they can use, to value, the liabilities. So because of no benchmark rate, the quality of the matching, between assets, investment, and liabilities, is generally bad. Yeah. So I'm wondering, whether we should consider, in Indonesia, implementing, a benchmark rate, for valuation of liabilities. Pak Pantro mentioned before the rates used, by the a lot of defined benefits founders, in the SOE environment, range from something like 6 to 11%, or maybe 8 to 11%. That type of range, is much higher, than the risk-free rate. The actual rate, they produce, was actually generally, below, the risk-free rate. So the gap, is big. So I'm just wondering, why, we're not moving to introducing, benchmark rate, for liability valuation, because that's gonna help, the investment. In Indonesia, we don't have as many tools, as you have in the UK, for example. Hedging, tools, are not readily available, here. So I think that's the question, Pak Adi.
Langsung Pak ya. Okay, thanks a lot Pak Rianto. Pak Rianto is remembering. We remember when we discussed past time ago, Pak ya, about the profession. But for sure, if we talk about rates, let's look at the banking sector first, Pak. Even in the banking sector, we're still far from perfect. Yeah, we have interest rate, we have KUR rate for UMKM, isn't it? Which is government supported. And we have also credit rate. Not to mention currently, Pak Mirza already indicated, look, we have BI rate that's currently is quite close to treasury bill rates. So Indonesia currently, we are currently having opportunity to review all of those rates. Why? Because our credit to small medium enterprises is the lowest compared to the ASEAN country, even ASEAN 5, for example. Why? Because now the current, if we talk about benchmark, that's the one I would like to refer back. If we want to benchmark using BI rate, what is the difference between BI rate to credit rate? It's still huge, still big. That creating indicators that we are currently far from perfect. We still need to work on our efficiency. What about in the pension or insurance system? To be frank, Pak, now we have also our friends from DPLK, DPPK, TASPEN, and ASABRI. Now we're talking about technical rate, we're talking about actual rate, or we are talking, like you already indicated, even for risk-free rate, are we now agreed that we are going to use, for example, BI rate, or even SBN rate, Pak? Yeah. That's we are long for, yeah, probably SBN rate that probably not only for 3 years, 10 years or probably more. I think that will be good for our benchmark in the future, yeah, yeah. But I think that's our homework now. The one that we currently would like to promote is actually when we review our investment policy, are we fair enough to contribute it to our participants or to our investors or pension fund holder? Or we are just focusing on our bonus, see, something like, or even not long term, but short term, yeah, focus. Okay, as far as we can have more than bunga deposito, that's good. No, probably more. I really agree with you, Pak. Please give it more benchmark rate plus something like to our pension fund holder. With that, I do believe, yeah, our great opportunity is actually as big as if we are currently can be trusted this industry, from 6%, if we do nothing, by 2045, we just only 11% per GDP, Pak, our pension asset. But with the transformation, with the reform, we can as much as be able to collect it 60% of our GDP. How much is our GDP 2045? Can be 9 trillion US dollar. It's huge fund. But we must consider these funds deserves our integrity, deserves our sustainability in terms of managing welfare for the people of Indonesia. With that, Pak, I do believe let's work together, Pak. I think we cannot work by ourselves. The government already set the regulatory framework. Now let's work together. Like our colleague from DPLK and DPPK currently just covering less than how many? 10%, 20% probably of the member. It's still less than 27% of our workers that currently, including BPJS, that are covered by pension system. So this is a lot need to be done together. But the opportunity is there. Let's do it and work with more enthusiasm. Thank you, Pak.
Okay, thank you, Pak. There's some questions as well from this system here, from Darwin and Faisal. I think I should join those two questions together. This is directed to Pak Shash. One is, do you think LDI is effective for all the DB pension, DBs, defined benefit pension funds, including pension funds in Indonesia, which we don't have much investment instruments options in Indonesia? One. Secondly, from Faisal, learning from the last DB pension downturn, how do you think LDI schemes can improve to mitigate the same problem?
Okay. So the first question around, is LDI effective in Indonesia? Was that the question?
Is effective for the DB pension funds, including pension funds in Indonesia?
Yeah, so that will be an easy, simple answer is yes. Because, so from my experience now, LDI is a staple allocation. It's not about is LDI effective, it's how you implement LDI. So we've moved away from is LDI effective. I think LDI comes in a lot of different flavors, and it's not one size fits all for everyone. So I think the question around is LDI effective, I think that's an easy question I can answer with a resounding yes. But how you implement it, depending on liquidity, instruments available, then there's a bit of a big question mark around how do you effectively implement LDI? I mean, that's a bit more of a prominent question there. On the second question, you mentioned is DB's pension schemes?
Yeah, learning from the last defined benefit pension downturn, how do you think LDI schemes can be improved to mitigate the same problem?
Yeah. So I guess that's where I was mentioning the risk management and the governance piece. So LDI, when you first put it in place, will evolve. So you don't, as you evolve, your pension scheme becomes more fully funded, you can take more risk off the table, which means making your LDI match more of your assets, more of your liabilities, sorry. So that's basically, another way of putting it is, if you start with a hedge ratio around 80%, and then you slowly increase that hedge ratio to about 100%, and then within that hedge ratio, how you implement it, you're taking away the kind of any derivative position, so you don't have to put up collateral. So then you de-risk that as well. So I guess the key question here is more around how would you kind of mitigate those kind of changes or the kind of downfall of DB deficits is making sure you have a robust de-risking plan in place and making sure that journey plan is in place in terms of it's working with your return-seeking assets, it's working with your liabilities as well, because your liabilities, back to the question about how it can be valued in various different ways. In terms of your discount rate can be based on your kind of accounting standard, your regulatory technical provision standard, it can be based on your insurance standards. These are all different levels of prudence, but you want to become the most prudent over time as well. So it's making sure you have those de-risking mechanisms in place in your LDI strategy.
Okay, thank you. Any questions from the floor again? Just otherwise, I will turn to the questions from the system here. There are two questions directed to Prakash from Timothy and Adi Millennium. Can you eliminate the net can you elaborate the net number between the value of government coverage and GIC return? So that one, and especially given the volatile market and high level of interest rate. That one. Secondly, second question is what kind of special purpose bonds that Singapore has? In Indonesia, government regulates us to buy infrastructure bonds.
Sure, maybe I can take the first question. So if you look at the last 20 years, GIC's average rate of return was between 7 to 8%. And then if you look at what the government was paying on the special Singapore government securities was between 3 to 4%. So there was a spread of between 3 and 4% from what GIC was making and the liabilities. Now, this is one area where I think you always have to look at the long term, because I think in a way, as what Pantro was talking as well, sometimes for over short horizons, you can get the capital market line being flat or inverted. But really over time, if you think it's upward sloping, which means that the more risk you take, the higher expected return you have, then you will get this kind of a premium from taking on more risk. With regards to your second question, so there are two kinds of special securities in Singapore. Now the thing is that these securities are not tradable, so they're just actually a way of transfer of assets. So one is between the CPF and the government, and the other one is actually between MAS, the central bank, and the government. So when MAS has some excess reserves and it wishes to pass it on to the government to manage, the government issues another type of special bonds called RMGS, which is a reserve management government security. But the idea is the same. The idea is that you're just converting one asset with another asset. But these two bonds are not traded in the markets.
Okay. There's another questions here in the systems. This is directly to Pak Pantro from Rahmah. Yeah. Pak Pantro, your solution will create crowding out effect for the market, as you propose specific treatment for pension and insurance. How to avoid the trap?
Will create what? Sorry. Can you repeat? Will create what trap?
Create crowding out effect for the market. I don't know. Is there any? This is from Rahmah.
Crowding out effect. I don't know whether it will crowd out effect, but I think there will be more incentives for people to participate in pension funds and longer-term insurance premium or policies, right? So I'm not sure if it's crowding out effect.
Probably it's kind of reducing the role of this private sector going on their own, and then there's instrument from the government, from the special.
Yeah, but this is actually a wide space that is not yet being filled by the private sector, because we're talking about long-term deposits.
Mm-hmm.
While typically, as we showed earlier, the typical profile of the pension funds investments are actually still short-term to medium terms. So I think this is actually quite good. In fact, I wanted to echo the questions from the previous participants on when can the government can implement this, Pak Adi.
Yeah.
Since we have Pak Adi here, and I think we've been talking a lot about how insurance penetration is still low, pension participation is still low. We're talking about infrastructure funding that is required, and now we have actually viable solutions. I think hopefully the discussion does not end here. Hopefully there's a continuation in further formulating the solutions. I mean, we would like to see a boost in penetration of both insurance and pension funds, as well as helping to grow the economy through infrastructure building.
How can we link it to the INA, for example?
Well, I think
it's possible.
I think it's certainly possible, but we have to look at the capacity of INA to also do the investments, right? INA was just recently formed, and I think it definitely has potential, but we're talking of a much bigger scheme and pool of funds. I think we don't have to rely on just one vehicle because the infrastructure projects are everywhere, right? So definitely INA can be one of the vehicles, but I think we just need to make sure that the funds flow to the projects.
So this is basically just approach to the pulling out funds, trying to probably make it, even if it is bigger, then can be looking for more opportunities.
Yes.
And also can reduce risk probably by this pooling of the funds there.
Yeah.
Okay. Is there any questions? Don't know from the system. We have still have 2 minutes more, about 3 minutes. From Auntie, one is already asked, and that's already asked. And from Sheila, as we know, pension funds has an objective for that enabling pensions secure and aim to provide long-lasting value. If the government takes role on it into it, it does have a challenge which the government must balance the risk with the perceived return. How do you see the ideal collateral arrangement to make the assessment so that the risk can be mitigated? Pak Wandro and probably Prakash can help as well.
Maybe Prakash
So can you repeat the question a bit? Sorry.
Yeah, as we know, pension fund has an objective that enabling pensions secure and aim to provide long-lasting value. That's basically a statement there. If the government takes a role into it, it does have a challenge which the government must balance the risk with the perceived return. How do you see the ideal, collateral arrangement to make the assessment so that the risk can be mitigated?
Let me try to answer that first. So we've been trying to review the pension funds in the SOE ecosystem for the past 1.5 years, and there are around 69 pension funds, defined benefits, 69 pension funds in the SOE ecosystems, 7 of which accounts for 80% of the assets. Mm-hmm. So 7 of the biggest accounts for 80% of the assets, which means the rest are very, very small. Now, when they're small, then their capability to hire investment professionals will be diminished. And in fact, net of OPEX, the investment return will be very small. Let's take, for example, if you only have 100 billion in your investment fund, then your OPEX is already 10 billion. And already 10% of your investments already shaved, right? So, I mean, the first statement was correct. It's for long-term, basically certainty of being able to pay for the liabilities or the obligations. Would you rather give that to just anyone with a small scale, or actually eventually the government would provide the guarantee? Right.
Yeah, that's basically one approach, yeah, to really, I mean, basically just pulling the funds to make it more capable of doing more, probably bigger opportunities, investment opportunity. Secondly, again, from the risk side, hopefully it can reduce the risk there. So let's discuss it further. Probably that is one of the proposal for this handling of the investment of pension funds, and especially the one which is proposed is link it to the infrastructure financing, while the experience from GIC can be bigger, more than that. It's not just infrastructure, but all, and it can also invest abroad even, yeah, a lot of investment abroad by the government of Singapore. So looks like time is up, and thank you again for the panelists. We can give a round of applause for the panelists, for the discussions, and also for the question from the floor. Again, thank you, and I return it to the MC.
Thank you, Bapak Anton Hermanto Gunawan, and thank you so much for our honorable speakers. Please give a round, big applause for this insightful session. Looking forward for another discussion in the future. And please arise, and we are going to continue with photo session. And before that, we are to extend our gratitude for the token of appreciation presentation. And for that, I would like to invite Bapak Fauzi Ihsan as Chairman of the Board of Commissioner Indonesia Financial Group to give the token of appreciation to our respectable speakers and moderator. It was insightful discussion with the topic of the second session, Pension Fund, Strengthening Investment and Asset Allocation Strategy. Thank you so much for our respectable speakers and also our moderator and everyone who are participating in the Q&A session. Really hope that everyone can get the message related to the topics and also get the benefit through it all. Once again, let's give a round of applause, ladies and gentlemen, for our respectable gentlemen, our speakers, and also moderator. And thank you so much for Bapak Fauzi Ihsan as Chairman of the Board of Commissioner Indonesia Financial Group. Thank you once again, gentlemen. You may return to your seat. That was our second session for the first day of IFG International Conference 2023. And I believe that we all had a thoughtful discussion and very intriguing insights from all of our respectable speakers. And that's a wrap up our first day of IFG International Conference 2023. And I have information for tomorrow's agenda. Our international conference will be held on the same room as today. It will be started from 9:30 a.m. to 5 p.m. Local time, filled with 3 interesting panel discussion with various background of sessions. In session 3, which will be talking about IFRS 17 and microinsurance, immediate task and prospects for the insurance sector. and on session 4, which will be talking about preparing the new ecosystem for the insurance sector. So please, I hope and I believe that everyone won't miss our Day 2 at IFG International Conference 2023. And also we would like to remind you to attend our special session tomorrow, which will be about strengthening the insurance sector through insurance guarantee scheme. And for everyone who will attend tomorrow's event, please to bring your ID card. And on behalf of the committee, we would like to thank everyone, distinguished guests, ladies and gentlemen, for attending the first day of IFG International Conference 2023. Once again, thank you so much for coming and really hope to see you tomorrow. My name is Shafira. Wassalamualaikum warahmatullahi wabarakatuh.